global economy. We shut it down and turned it back on, and it's coming with a lot of messy frictions.
You've got a ways to go to get to pre-pandemic employment.
I'm against the view that we're in the roaring 20s and that we're going to leave a new era for U.S. growth. I think we're just back to normal.
We do think it's transitory, but we also have to admit that there is a very fair chance that inflation will turn out to be sticky.
If you step back and think about what's going on, it's very, very clear. We are borrowing from the future.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures up by almost 0.1% as we count you down to the payrolls report tomorrow. Tom Keene front and center. I think the biggest issue in global business right now, a vaccine waiver, a waiver on IP rights to those vaccines produced by several big pharma companies worldwide. That is where the U.S. support lies right now.
It's nothing more than copyright. It's all there is to it, John. It's been a debate that's gone on forever, led by Merck. I think of the great Gordon Douglas, who ran all the vaccine programs at Merck over the years. Good morning, Dr. Douglas, down in New Jersey. But, John, I would say it's a huge, huge deal. And as you and I have discussed, Ricardo Hausman, the acclaimed Harvard economist, says it's real simple. Pay the drug companies for their research.
Yeah, but that is not the way things are progressing right now. Tom, we've got to ask some simple questions. Should we be helping low and middle income countries get access to the vaccine? Absolutely. That has to be the starting position. Then we have to ask ourselves, what is holding back the supply of vaccine right now? Is it IP? Is it technical expertise? Is it raw materials? Is it supply bottlenecks? I think the optics around this story is pretty obvious, isn't it? The substance, far less so.
Yeah, well, that's true, but mostly it's a conflation of fixed costs and variable costs, and somebody's got to help the fixed costs of creating these miracle drugs, whether it's COVID or, frankly, anything else. John, everybody agrees the system's been screwed up for years. Trump took a very different position than Biden. There's no question about that, but it's looking for a constructive solution, and you have optimists like Professor Hausman saying we can solve this tomorrow.
Yep, and others, including Dr. Fauci, Lisa, saying if you go ahead with this, he's raised questions about it. Even if you think this could be effective, we could be talking about this through 2022, and before you even hand over the technology, it could be early 2023.
Well, and the question is, what precedent does this set for the entire vaccination industry, as well as just pharmaceutical in general? If there is a crisis, does this mean that the U.S. will waive the IP protections? What does that mean for investment in the biopharma space? There is a question here going forward, particularly about the mRNA technology of BioNTech, et cetera. The idea here that if you reveal the IP, does this allow some of the breakthroughs from other companies? And is this actually beneficial? I will say this, there's a question. Nobody wants to pay for this, yet the money is what drives the innovation. And this is the sort of tension that we have in the market today,
I don't think anybody wants to be seen asking the tough questions either, Tom. I think that one single perspective has monopolized the moral high ground on this issue right now, and we can't marginalize legitimate questions on what has to be asked. Big questions. I think we should be celebrating what's happened in the last 12 months.
Yes,
public-private partnership that has delivered a vaccine in record time.
Look, we remember the skepticism of mRNA research and the ability to do this. The bottom line is, as you say, celebrate, John, is the home run delivery of this by drug companies centered mostly out of the United States of America. And that industry was founded on patent and copyright, intellectual right protection. And the question is, how do you structure a process so they get compensated? Everybody's on this side or that side, and nobody's talking about what's the process or solution. And I go back again to Ricardo Hausman, who says, look, there's a solution. Let's get to it.
Professor Stiglitz joining us a little bit later this morning to weigh in on this topic. I understand he is euphoric about the decision of the U.S. administration. We'll have some questions to ask through the next several hours. I want to look at the price action just briefly. What an interesting market we're looking at in America. The S&P 500, 4163, up about 0.1% on the session. We are very, very focused on what is happening with real yields. Real yields are deeply negative, yet tech is not outperforming. The financials are. energy stocks are. Energy this morning, WTI 65.32 and down about 0.5%. Lisa, this is a nuanced market. Let's borrow Tom's phrase from earlier on in the week, and I think we've got a lot to talk about.
It's nuanced, but it's not a snooze fest. And I think that perhaps that's the distinction to also borrow from Tom's lexicon. There is a question here, especially if you look at the inflation break-even rates, which are reaching the highest levels since going back to 2006. If you look at the 3-year rate, the idea here that people are pricing in inflation, but it's not representing itself in the absolute yields. If you take a look at what we're looking at today, 8:30 a.m., we get initial jobless claims. These have been very noisy. However, still perhaps giving some tea leaves ahead of tomorrow's payrolls report, which will be interesting. 12 p.m., I am actually really closely watching this. The House is holding a hearing on GameStop and all the volatility in markets around that. I find this interesting because yesterday, SEC Chair Gary Gensler came out and indicated that he would be willing to have more regulation on the likes of Robinhood and Citadel in the wakes of what we saw on GameStop. This, I'm sure, will affect a lot of people, in particular retail traders. And then at 4 p.m., this will be interesting as well. The Fed releases a financial stability report, and this comes after Fed Chair Powell used the F word, frothy, that there are pockets of froth in markets. We're hearing increasing concerns about financial stability on the fringes among Fed members. How much will they highlight that? Where will they look for those pockets of froth? And I'll just note that the Boston Fed's Eric Rosengren yesterday indicated that the mortgage market really had his concern, John, that possibly the Fed will have to take a look at the balance of mortgage-backed debt versus treasuries that they purchase each month in order to prevent this market from overheating.
That's the F word in Fed speak, froth.
Yes.
Lisa, I love that. I do love that.
5-letter word, yeah.
Let's talk about where yields are just briefly. Tom, nominal yields south of 160. Real yields deeply negative. In the last 24 hours, I've heard a lot of talk about inflation expectations, break-evens, breaking out. I haven't heard enough on what's happening with real yields as that's happening. Nominals have stayed really stable. So real yields are much, much deeper into negative territory. And if you look at the equity market price action, I've been pretty confused by it. We break down the sector price action yesterday, Tom. Top of the pile, energy financials. Bottom of the pile, you had tech in the mix, you had utilities in the mix. If I showed you that equity snapshot, you would think that real yields were inflecting higher, and that's not what's happening.
Yeah, I totally agree with you. You and I have gone back and forth on this, and I think there's a lot of good work out there on it. I would say there's basically a hysteria of gloom out there, John. When I look at Standard & Poor's 500 coming from the trend of 2007, we exactly kissed up 2 standard deviations, and we've pulled back a little bit to our extended 1.5 standard deviations. That's not a correction. It's not a bear market. It's stasis at new high levels.
I want to bring in Charles Cantor now of Neuberger Berman on this topic. Charles, can we just start there? Your thoughts on what's happening in the bond market and whether you can reconcile it with what's happening in the equity market more recently?
Look, I think the equity market is the volatility driving the equity market is being driven by really 3 factors, I think. One is just overall speculation, with retail being 20% of the market. I think as more and more folks go back to work, the retail thing will decline. And then you have inflation front and center, where as you've discussed, you have this debate around, is inflation transitory or is it more likely permanent? And for now, with 10-year yields starting with a 1 handle, I think the bond market remains reasonably calm that the inflation debate is more transitory. I would question that over time. I think the bond market's going to move well before the Fed moves. And then you have, the volatility driven by the factors, and it's small versus large, value versus growth. And on a day-to-day basis, it's those are the factors driving the volatility. I think over time, as we've discussed before, it's just been an awesome earnings season where over 90% of the companies have comfortably beaten expectations, and as earnings go, so goes the market, and that continues to be true this year.
Charles, good morning. Tom Keene in New York. Charles, I look at where we are off a 2009 log chart on Standard & Poor's 500, and we exactly went up and kissed 2 standard deviations extended. Okay, the market's a little bit extended now, but when you and Neuberger Berman monitor corporate revenues, corporate earnings, can you suggest we're extended out 1 year, 2 years, 3 years, or are we building an underpinning of cash flow that will sustain this market?
What will sustain the market is earnings driven by economic growth, and we should all recognize that the economy right now is experiencing a demand shock, the likes of which we haven't seen since World War II. And it's been driven by, we have three factors in the economy, all pedal to the metal at the same time. The consumer, the corporation, and both fiscal and monetary policy are all in it together at the same time, and it's slowly going to be coordinated globally. And as those factors continue to play through, you're going to get more and more earnings. So we started this year at 185. We're close to 200 now in S&P earnings. Next year, after adjusting for higher taxes, you probably get another 10% growth. So I think follow the earnings. I think we underwrite businesses, hard to underwrite price volatility day to day. But I think the demand shock's going to play out for far longer than people expect as corporations, consumers, and governments continue to behave in the way they behaved over the recent past.
Charles, just real quick here. Leon Cooperman yesterday described himself as a fully invested bear. Are you on the same page?
You got to believe in innovation, prosperity, and growth over time. And so guessing market direction is not my true north. I'm trying to be an authentic long-term investor focused on businesses that compound. And what I do know is that if you can find a business that can grow 15% a year for 3 years, you have 50% more earnings 3 years from today. That builds in an awful lot of protection on any price volatility. So I tend to be a reasonable optimist. I feel emboldened by what transpired last year, by innovation and governments and companies coming together to solve something just awful. And being optimistic has always paid off long term. And there's nothing about risk assets today that suggests to me in total that they're overvalued. Of course, there are parts of the market where speculation is rampant and where stories are so great that can't be validated nor refuted. But focus on businesses that are solving real problems that have long-term moats, and I think investors are going to be just great.
Charles, it's good to see you, and it's great to catch up. Charles Cantor there, Neuberger Berman, Long Short Fund, Senior Portfolio Manager. I think how you frame this right now really reveals your underlying bias. If you're focused on inflation, you're focused on the end result. If you're focused on the demand shock, Tom, that's really what's happening. The demand shock that this country, this economy, the global economy is going through.
The gaming of a boom economy forward, to me, John, is a real mystery.
Coming up in the next hour, Darryl Cronk, Wells Fargo Wealth and Investment Management CIO from New York City this morning. Good morning. Lisa Bravitz, Tom Keene, Jonathan Ferro with equity futures higher. This is Bloomberg Surveillance.
With the First Word News, I'm Rishika Gupta. President Biden says he's open to compromise on raising the corporate tax rate. The president has called on Congress to boost the rate from 21% to 28%, but he now says it doesn't have to be exactly what he says. Democratic Senator Joe Manchin has said he could support a 25% corporate rate. The U.S. will support a proposal to waive intellectual property protections for coronavirus vaccines. U.S. Trade Representative Catherine Tai told Bloomberg the U.S. wants better access, more manufacturing, and more shots in arms. Drug makers are opposed. They say few countries have the capacity to make the vaccines, even if they knew the formulas. Meanwhile, Moderna's coronavirus booster shots gave positive results against strains of the virus that have emerged in South Africa and Brazil. That's according to early results from a mid-stage trial. The boosters had some side effects comparable to those seen after the second dose of Moderna's existing vaccine. Jeff Bezos has sold about $2.5 billion of Amazon stock this week. It's his first big disposal this year after offloading more than $10 billion worth of shares in 2020. In a filing, Bezos signaled that more sales are on the way. The world's richest person still holds more than 10% of Amazon's shares. And SpaceX nailed the landing in the fifth test of its Starship rocket after reaching an altitude of about 6 miles. The rocket made a controlled descent to its launch pad in Texas. SpaceX founder Elon Musk sees the rocket as a future workhorse for trips to the moon and Mars. NASA recently picked SpaceX to develop a moon landing system with Starship. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public.
Okay, traders, let's cancel order to buy Bitcoin, because as you can see, it moved really far away from our order. So we'll probably sell short soon. Okay, if you decided to place order with me and buy Bitcoin right now, was tough luck. Yeah, we need to cancel the order, and we'll wait for next chance to trade Bitcoin. Okay, order to buy canceled.
Wake up with Bloomberg Surveillance, weekdays on Bloomberg Television.
We are ready to discuss how the U.S. proposal for waiver on intellectual property protection for COVID vaccines could help achieve that objective. In the short run, however, we call upon all vaccine-producing countries to allow exports and to avoid measures that disrupt supply.
It is the political hot potato of the moment. It's Ursula von der Leyen there, European Commission President, responding to a US proposal. From New York City this morning, good morning. Alongside Tom Keene, Lisa Brabitz, I'm Jonathan Ferro. Is the price action right now? 41.64 on the S&P. We drift higher by about 4 points and advance 1/10%. Yields unchanged on 10s, 157. Yields lower through the week again. In the FX market, 120.47, up 1/3%. Euro showing some strength. Crude showing some weakness, 65.45 and down about 1/3%. This discussion around corporate taxes, Tom, just briefly, maybe being open to taking the rate from 21 to 25. What's interesting is if you go through the research for next year, RBC, Credit Suisse, what are they plugging into their forecasts? 25% on corporate taxes. So maybe that is the number.
Well, that seems to be the number, but, you know, and I would say, John, just on the taxing here quickly, the basic idea here is it's about 2022, and the ground has shifted in the last 2 weeks. Some of these votes that we're seeing in the 17th District of Illinois, the 6th District of Texas, they changes the calculus. I mean, I think it's a very movable feast right now about where the compromise will be on that. Someone who knows compromise, Ben Bain, joins us with Bloomberg News in Washington. Ben, there's like 7 topics today, but I really think we've got to go to the patent discussion because it is such a stark discussion between the Trump administration and the Biden administration. How big is that political divide on how U.S. companies should be compensated for their intellectual value? How big is that divide in your Washington?
Well, I mean, it's night and day. I mean, this was, the Trump administration was against the idea of offering this waiver for IP patents. And now, yesterday, we heard the U.S. Trade Representative, part of the Biden White House, essentially saying that, you know, extraordinary times demand extraordinary measures. And indeed, there should be a temporary waiver, at least, for these patents. So it's really a complete reversal here. This is also, you know, of course, coming amid the horrific coronavirus outbreak in India and elsewhere in the developing world. And what we're seeing, I think, is the Biden administration taking a different tactic to re-engaging in some areas that maybe the Trump administration had a much different approach to. And this is really one of the first kind of public health international moments that we're seeing here, and we're going to see in Washington whether the president's party is going to be all in line with him and actually granting these waivers. It's going to be a political hot potato, if you will, over the next several weeks for sure.
Ben, I think how we frame this is absolutely critical right now. This is not about whether we should or should not help low and middle income countries. That's not where the debate is right now. I don't have a single person that does not want to help low and middle income countries, Brazil, India, countries that are really struggling right now. It's how we help them. When you listen to the European Commission President, Ursula von der Leyen, just listen to the language here. We're ready to discuss how, whether it could help achieve that objective. Why has there been a decision by this administration that it will? What have they seen? What has led them to believe that it is not raw materials, it's not supply bottlenecks, it's not expertise, it is all about IP protection?
Well, during the campaign, then candidate Joe Biden discussed this, and he said he actually wanted to do this. So I think for a while there's been a sense among him and his inner circle that this was something that, you know, could actually ease the bottleneck and move ahead. You know, what we've heard since this came out yesterday is the pharmaceutical industry pushing back pretty vigorously and mentioning some of the things that you're raising. So, you know, complications, they say, around actually ramping up supplies, actually setting up factories. So, you know, the idea that at least the industry is saying just by temporary waiving these patent rights, you're suddenly going to be able to produce vaccines in a different country, you know, the pharmaceutical industry is saying it is maybe a little bit far-fetched. So for the Biden administration, they think this is a key step. They think this is something that needs to be done to solve some of the problems in India and Brazil, South Africa, elsewhere in the developing world. But, you know, industry is already pushing back, and I'm sure it's only the beginning. We're gonna see this play out in Washington, you know, and really in Europe and elsewhere around the world over the next several weeks.
So, Ben, it seems like, and correct me if I'm wrong, it will take a very long time for this to actually go into effect, for these IP, intellectual property, the details going to companies in places like India for production locally. So in the meantime, and do correct me if I'm wrong with that, in the meantime, is the U.S. materially ramping up their exports of existing vaccines that they have stockpiled for people who don't want to take it in the United States?
So, yeah, earlier this week, the president gave a speech in the White House where he said just that. The U.S. was looking to ramp up, you know, its export of some of these vaccines that have been stockpiled here in the U.S. So that's another thing that the Biden administration is trying to do. You know, they've also taken some heat from progressives here in the U.S. and also abroad, because there is a view of many critics that the U.S. should be moving quicker here. As you mentioned, there are people in the U.S. who are not willing to take the vaccine. There are stockpiles in many states right now, and there are countries around the world that don't have the vaccines that they need. So there are people who are saying the U.S. should move much quicker, get those vaccines out of this country and into people's arms in places like India. And the Biden administration is kind of trying to walk a line here where they have to try to get as many people as they can vaccinated in this country, even though there is some hesitancy still in many communities, because you're never going to get to that herd immunity unless you get more people vaccinated here in the United States. But also, the U.S. moves so quickly here. The U.S. has 3 approved vaccines here, in addition to AstraZeneca stockpiles, that the rest of the world is saying, hey, give us some more. They've sent some to Canada and Mexico, but elsewhere in the world is also waiting for more.
Ben Bain, down in D.C. Ben, thank you. Tom Keene, this is the situation to debate this morning. I think the emotional response to this conversation is obvious. This makes sense, doesn't it? We want to help people save lives. Of course, everybody wants to do that. Whether this is the way to do it is the debate we've got to have. And the risks around it need to be talked about.
I take a distinction there with Ben Bain about the polarity involved. Maybe being in Washington, you're always seeing the polarity. I thought the Biden approach was a bit nuanced towards a discussion, towards a narrowness on the specific COVID-19. But it's real simple. The smart people that make these wonder drugs don't trust them. That's all there is to it, John.
Yeah,
I mean, this has been going on forever. This goes back to measles, German measles.
This is the great concern people have. This is the great concern that people have, that Lisa, this will be the first step towards something else.
Yeah, the idea here of potentially opening up not only for another crisis, but just in general to drug production, if you remove some of the financial incentives for biopharmaceutical companies to innovate, what does that do long term? That said, the Biden administration has been very clear, John, saying that this is a one-off, it is a very specific situation and does not set a precedent. And frankly, the moves that you're seeing in the market seems to edify that people believe that for now, John.
But what we've also seen over the last year, over the last 6 months, is that a vaccine alone is not enough. You also need the right policies. India, Brazil, the two countries that are pushing for this IP waiver,
well,
arguably at the moment, Tom, have the worst leadership on this pandemic.
And can they manufacture and execute the intellectual input?
Yeah.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
From New York City for our audience worldwide, this is Bloomberg Surveillance, and here's the Thursday morning price action. Equity futures bouncing back by a little bit more than 0.1% on the S&P, up about 1/3 on the NASDAQ, on a Russell by about 0.4%. Want to identify a little bit of tension in this market. This is how we're going to do it. Let's switch up the board and go through the sector-by-sector story of the last 24 hours or so. S&P 500 energy up by more than 3% on the session yesterday. The bank's up by 1%. IT down by about 1/10 or so. The utilities off by 1.7%. If I showed you that sector snapshot, and I talked about this a little bit earlier this week, where would you think rates were, both nominal and real? I've seen inflation expectations break out. There's been a big conversation about that. But let's talk about where real yields are right now. Switch at the board and finish on this. Isn't this the chart of the moment, Tom Keene?
Yep.
Negative 91 basis points on a 10-year real yield in America. What happened to the story of real yields in IT correlating? What's happened to that?
100% true, and it's
broken down.
It's rolled over, and John, what's so important is it's an elegant rollover. There's a real inertial force to the quality of the rollover.
Lisa, just a beat on this if you can.
Yeah,
I think
Leanne.
this is the tension of the moment between the equity market and the bond market. Just real yields rolling over, and the equity market seems to be doing its own thing, responding to something else.
Leon Cooperman yesterday touched on this, and I thought it was fascinating. He said that the main thing he was looking for in terms of equity performance was Fed speak. That says everything you need to know, John.
So I'm going to talk about how this reconciles, because you do start to see things like this happen, and ultimately over time the story reconciles again. But which way? Real yields higher, equity market lower, sector composition moves the other way?
I think we know. We don't know, John, and I go back to the real economy.
But I've got a call from Chris Verone a little bit later that I'll bring to you in about an hour on what he thinks happens here. We'll do that a little bit later, Tom.
Okay, well, very good. There's a study here of a most unusual market as well as a most unusual pandemic. We halt here on our economics, finance, and investment and try to figure out what this vaccination program means. We've gone out and found a token grandfather who will actually see his grandchildren for the first time since time began. David Blanchflower joins us, grandfather, Hanover, New Hampshire, this morning. Danny, the kids show up here in the coming days.
Absolutely. First time in 15 months that my grandkids are coming today. So, you know, things are starting to get back to normal, and that's the story we're hearing on the economy, of course, but it's, you know, but it's slow progress. I mean, we're seeing fast recovery, but never back to where we were before this awful pandemic hit.
I want to go back to the distinction of your book, The Wage Curve, a million years ago. David Blanchflower, very simply here, there's a mystery here to what wage dynamics will do as we bring on millions of service sector lower wage employees. Are you worried about rising wages and benefits?
No, I've been worried about the lack of rise of wages and benefits over the last 15 years or so. And obviously the big puzzle in the data is that we've actually seen wage growth which is so strong, it just makes no sense. So when we saw the unemployment rate in the US go from 4 to 15, we saw wage growth go from 3 to 8. And the reason for that has been obviously the dropout at the low end of the wage distribution. So for folks like me trying to understand what's happening to wages, it's pretty complicated. I was looking at the same data for the UK today that the Bank of England are going to look at, and it's just as confusing there. There's an election going on in Scotland, and if you look in Scotland today, the unemployment rate in Scotland is lower than it was in March 2020. And so the data in the labour market are pretty puzzling, and a lot of it has to do with furloughed workers, bottom of the wage distribution dropping out. And in a sense, certainly the argument that I'm going to worry about wages really picking up seems most unlikely to me. People talk about shortages, but there's plenty of labour out there. There's many firms that haven't recovered and are probably going to close. So I think adjustment's going to be complicated. But the last thing in the world I really care about is that wages are going to explode. They are not.
Danny, for regulatory reasons, let's avoid the domestic politics talk over in the UK and focus on the labour market here in the United States if we can. The world has come to you. Every single Payrolls Friday used to come on Bloomberg Radio with Tom and I, and we'd talk about the labour market. And you were the class clown. You were the guy that came out and said, look, you're wrong. You're all wrong. And everyone said, oh, here goes Danny. Danny going at it again. The labour market's not tight. Look at where unemployment is. The guy's an idiot. Danny, everyone agrees with you now. So I want to ask you, when you look at the labour market in months and quarters to come, what's the data point you'll actually be looking at? If it's not the unemployment rate, what is it?
Well, Well, I've certainly looked at other measures of labour market slack. So I like the employment rate. I like the underemployment rate, but particularly part-time for economic reasons. But I think the adjustment of wages are really the big story. I mean, that shock I just talked about occurred in the US. It's a big puzzle. And I think if you look back at what happened in the US between 2015 and 18 and what the Fed did, in essence, they didn't listen to what I said. They said, oh, we're going to raise rates because of full employment coming. Wage growth is about to come. That didn't happen. Jay Powell has sort of given the mea culpa. But I think what we have to watch is what happens to wage growth, what measures really are there suggesting that the labour market is very tight. And I think the story I've said to you many times over a long period, which other people disagreed with, was that unemployment can surprise on the low side, and basically we should sit and wait and allow the economy to adjust. And I think that's where we're going. So I'm going to really watch wage growth. I'm going to see how it progresses, but I'm going to watch it come down as people come out of furloughs, they come out of lockdowns that they've been in, and see what recovery comes. But I think we just sit and wait and watch, and that's the right strategy of the Fed. I listened to Jay Powell. I thought he was fantastic. Absolutely got it. But if you like, he's just been saying what I've said over the last 5 years, which people disagree with, but essentially turned out to be right. You need to understand what's happened in the labor market, and that's where the adjustment is. But you want to look at multiple indicators. And remember that the employment rate never has got back to where it was in 2008, never did. And I think that was a mistake most people made. And lots of commentators on Bloomberg that I spoke to many times just got it wrong.
Well, Danny, there's also a question about what policies could materially increase wages going forward. And we hear this increasingly from the Biden administration with the taxes that he's proposed, as well as the support of unions. What policies traditionally in your economic research have effectively raised wages, increased productivity, made a fairer labor market?
Golly, a tough. I mean, the first answer is you move towards full employment, but also you give incentives for firms to hire people. I mean, one of the stories about capital and labor is why firms invest in capital is because its relative price is lower. So you try and make the labor price lower. I mean, the story about unions, I mean, unions are fine if you can generate rises in productivity. So I think help to make workers more productive, help share in profits that are available. And I think one of the stories we have to think about is for a very long time, firms were able to pay higher wages and chose not to. And the question is, why not? They paid salaries to executives and so on. So you can encourage firms to hire people. You can give them tax incentives to people. And one of the big stories is you can give wage incentives to people, earned income tax credits, that kind of thing. But essentially, you start to say it's very important to have a shift from labor to capital, perhaps because the balance moved too far in one direction. But I like the idea, move towards full employment, allow wage growth to come, and perhaps the balance between labor and capital has to adjust. Because I certainly think the levels of inequality
you sound like a professor.
Danny, the Biden administration is doing with my friends Janet and Cece.
You sound like a professor from Dartmouth. Danny, let's cut to the chase, and we don't have enough time to get into a lecture. You and I are in a classroom up at Hanover, New Hampshire, and we're talking about the unique politics of the Biden Democratic Party. How alone is Joe Biden on wanting to get back to a labor vision from another time? Is it a one-off that evaporates when he's gone, or is there a real new substance here for a new labor vision in centrist America?
Yeah. I mean, I think that's a really good question. I mean, I think in a sense that I always thought the last decade was the decade of the central banker. Maybe what we've seen now is a new decade coming of the labor economist. Well, why do I mean that? Well, Janet Yellen, labor economist, ex-central banker, but basically in her acceptance speech talked about the importance of improving the labor market, improving wages, improving jobs. C.C. Rouse, chair of the Council of Advisors, another labor economist. Members of the Council of Economic Advisors are obviously labor economists. And the recognition is you've got to do something about the labor market, not least those people who've been essentially left behind. You've got to do something about real wages in America, and especially do things about people with high school education and high school dropouts, something about those folks. So I think there's a recognition, politically a recognition, but in terms of the labor market, we have to do something about those people who've not benefited from the American dream. And I think the Biden administration has recognized that. Look at who they have appointed. So I think Janet's talked a lot about that. So I think the new recognition has to be, we really messed up what happened in the labor market. And I think Biden's right, and he's moving in that direction, and looks like quite a lot of public support for it.
Danny, the world came to you on the labour market. It's great to catch up. Danny Blanchflower, Dartmouth Professor of Economics. Just to give you a flavour of expectations going into tomorrow. Expectations 998. That is your median estimate. Your low and your high. Your low 700. Your high 2.1 million.
John,
let me go through some numbers, Tom.
You just underplay
2.1 over at Jefferies. Standard Chartered at 1.5. Goldman at 1.3. Lou Alexander of Nomura looking for 1.3. Brett Ryan over at Deutsche Bank 1.275. 1.25 over at Morgan Stanley. So I keep going.
What, you just going to say go to cash?
Just so, well, we went to 998,000. John, we surged. I say surged from 995,000 up to a survey of 998,000.
Yeah.
Surged, I say.
Surged.
That's the American way to look at this.
Expected.
We surged.
I just thought I'd go through it without the emotion.
Yeah.
Without the enthusiasm.
It's America. We got to do this to keep people watching and listening.
Tom gave the emotion. He gave some excessive emotion.
You want to commercialize the jobs report?
Yes, he does.
We surged. Brought to you by.
He's going to create a new drinking game around Surge.
Surged.
Yeah.
Okay.
Surged.
There's going to be
Amazon
I'm going to break. Coming up, Dr. Jennifer Nuzzo, Johns Hopkins Center for House Security, senior scholar, the skill, the tactic, the strategy. Just keep talking. Keep talking. 41.68 on the S&P, up 0.2%. Yields unchanged at 156.43 on 10s. Euro dollar pushing higher. Your euro stronger, your dollar weaker. Euro dollar 120.46. Alongside Tom Keene, Lisa Brambitz, I'm Jonathan Ferro on Bloomberg Television this morning. Good morning. This is Bloomberg Surveillance.
With the First Word News, I'm Rishka Gupta. President Biden says a corporate tax hike doesn't have to be exactly as much as he wants. The president indicated he's willing to compromise on one of the key features of his infrastructure and jobs proposal. Democratic Senator Joe Manchin says he can't go for the president's proposed increase from 21% to 28%, but he could support a 25% corporate rate. British Prime Minister Boris Johnson made a final push for votes before today's so-called Super Thursday elections. It's a major test of support for his leadership and the ruling Conservative Party. The pandemic forced one set of local elections to be delayed by a year, so 2 years' worth of voting will be held today. Amongst the races, local councils, the Scottish and Welsh parliaments, and the Mayor of London. Uber says that the cost of recruiting drivers will have an impact on earnings in the second quarter. That's one more hurdle in front of the company's goal to turn a profit by the end of the year. Uber expects that bonuses and other incentives to get drivers back on the road will reduce the rate the company takes from fares by about 20%. And the luxury home market in New York is showing early signs of recovery, according to broker Knight Frank. Prices in Manhattan's most expensive districts rose 5.9% in the year through March. That's the first annual increase since last April. Meanwhile, rents in central London's best areas are still in the doldrums after falling 14.3% in the same period. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
We're also seeing a really strong recovery.
No one delivers the data faster.
Nestle's out with numbers. Can this company continue at this kind of clip?
Bloomberg Television, your home for earnings season.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
As this data is going to be coming out, we also are seeing strains in India that seem even more ominous than the South African one. And so the question will be, how is that going to fare against these new boosters? Do we need another booster? And look, lest people think that we're going to be stuck in this battle for a long time. We are going to be stuck in this battle for a long time, but at least now we have a weapon to deal with it.
We have a weapon to deal with it. That was the Moderna chairman from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Here's your equity market this Thursday morning as we count you down to initial jobless claims in America. An hour and about 42 minutes away. Equity futures up by 6 points on the S&P 500 to 41.65. We advanced a little more than 1/10%. Yields unchanged at 156.43. Inflation expectations, break-evens breaking out just a little bit to new highs in the last decade or so. Even more on certain maturities. For the real yield, though, even more deeply negative. And that's at the epicenter of our market conversations this morning. Your nominal yield this morning, Tom, 156.43 on 10s.
Yeah, the data here is really important. As John mentioned earlier, the dynamics on data here and into these claims at 8:30 and the jobs report tomorrow is really, really something. Right now in this pharmacy uproar, we get lucky. Jennifer Nuzzo joins us. She's been with us before with Johns Hopkins Center for Health Security. And Jennifer, I want to go to that moment in organic chemistry where you realized at Rutgers in environmental organic chemistry, oh, this is my
really, recurring nightmare.
Really,
I thought I would be having this exact question.
All of us. Hard. I mean, methylethyl ketone in organic was easy. And then I opened Morrison and Boyd up and I said, these people are freaking geniuses. Let's go back.
You're bringing it all back.
Yeah, you know it all back. Let's go to the gross underestimation here of the geniuses actually manufacturing mRNA. They passed Morrison and Boyd, didn't they?
They did, and thank goodness for it, because these vaccines are lifesavers, literally.
Well, they're lifesavers, literally, but I think there's an underestimation here of those intellectual rights of those drug companies. How do we move from intellectual rights to the crying need to vaccinate India?
Yeah, that's exactly the question. I mean, completely understandable. I think in the case of Moderna, the good news is that, the U.S. government, developed the vaccine, the IP on that, but it is an urgent situation for us to address because we do have a crying need. And it's not just in India. I mean, the situation in India is just staggering. Yesterday, they broke yet another record of, more than 400,000 cases. We know that that's probably a gross underestimate of the number of infections that are occurring, nearly 4,000 deaths in a single day. But we're also seeing staggeringly high case counts and case acceleration in a number of other countries that are, ill-equipped to handle it themselves as well. So we have to figure this out. There is an urgent need for vaccines across the globe, and we just simply don't have enough. We need to make more. So we need to figure out whatever path is possible to making more vaccines as soon as possible. That's the only way we're all going to feel normal about this situation, even as we roll out vaccines here in the U.S.
We've got to make more. That's the conclusion, without a doubt. That's the starting position. So, Doctor, let's try and ask the right questions. At least that's my job. What do you think is holding back vaccine supply? And do you think IP protection is the biggest obstacle to that?
You know, I don't think there's any one big obstacle. I think there's a series of lots of small obstacles. You know, it appears that IP protection may be one of the issues. I think we really need to have a detailed analysis of what the issues are. We also know that shortages of raw materials are an issue. We urgently need a situation where we can track this at the global level to understand where the raw materials are, to get countries to stop hoarding whatever they have. I think actually more transparency in the global supply chain would help some of those hoarding tendencies. But we need to do this in a concerted way. I mean, this whole like each country go on its own in order to vaccinate its own population is really not sufficient in a global pandemic, because what we have now is a few countries that have more than enough vaccines for its highest risk population, and most countries having not even close to enough to vaccinate even its healthcare workers who are putting their lives on the line every day. So we need to figure out something, and just the current amount of vaccine we have is not sufficient to address the most pressing needs.
Dr. Nuzzo, let's try to strip out the political noise here. How much is the IP issue a distraction based on the length of time that it will take to get through and actually affect the pandemic as we know it right now, versus looking at the stockpiles that places like the United States has and deciding how much the U.S. ought to be shipping out while also making sure that its population is covered?
Yeah, so we need to do all of it is really the thing. I mean, we need to make more, but making more, even, IP issues or not, is going to take time. So we have to think about how we're going to use the vaccines that we have. And, I think it is great that we've made so much progress in vaccinating adults here in the U.S. This is bringing down our case numbers, and I expect we will continue to see case declines over the coming months. Israel and the UK, their case numbers are way down, and I expect that we will get there. But the question is, what do we do with the other vaccines? Do we keep it for ourselves? Do we start using it in our kids? These are tough questions when we have such urgent needs across the world. Maybe now is not the time for us to be vaccinating low-risk populations. Maybe we can share some and come back and do that. We need to figure this out. I don't have all the answers, but I do think that our failure to answer these questions is what's not ending this pandemic.
Jennifer, I got one final question. I just figured out that Morrison and Boyd's 6th edition cost $228, which is enough to start drinking early. Look, Jennifer, what's so important here, seriously, how do we move an mRNA vaccine with cold storage over to Mumbai or rural India? To me, that's a fiction.
It's actually not. And the reason why I can say that is that we have used vaccines that require ultra cold chain conditions in low resource settings. Like the Democratic Republic of Congo used a vaccine that requires cold storage, to address its Ebola problem. So it is not a challenge, but it is one that has been worked on before.
John, this is a problem. Every time Dr. Nuzzo's on, I learn something.
Every single time.
I'll try harder next time not to do that.
Doctor, before you run, I think we've got to tackle an important domestic issue as well. 2.13 million vaccines per day. That's the average over the last 7 days. When are they going to show a little bit of confidence about what vaccinated people can do?
Let's do it now. I mean, I was saying just before I came on, I'm fully immunized as of Friday, and I'm, plan to take advantage of that and, go out and do more things than I have done for the last year. I think we have to talk fairly about vaccines, that they're our pathway back to freedom, for sure.
And reclaiming those freedoms seems to be the big objective. Doctor, it's good to catch up. Jennifer Nuzzo there, Johns Hopkins Center for House Security, senior scholar. The debate at the moment, Tom, there's two of them.
Well, it's true at the moment. I mean, this is a real swirl, John, but I would bring it back into what we're talking here of the markets and of jobs as well. This is, we forget, John, it's a boom economy. All of us, I'm as guilty of this as anyone. How do we perceive 7, 8, 9, even 10% economic growth? We have no history of understanding that.
It's a demand shock that we've got to work our way through. Can supply meet that demand? And on labor shortages, I wonder what difference it would make if we gave the people who had been vaccinated a little bit more confidence to go back to work, Lisa. I wonder what it would mean if we gave the hesitant a little bit more confidence to say, this is what you can do if you're vaccinated.
I was back to school. I was at McDonald's at lunch yesterday, and they were stacked up waiting to get into the restaurant.
Any story that starts with I was at McDonald's,
just disregard.
I just know didn't happen, apart from one time at Liverpool Street with you and I. A long time ago.
That's a photo opportunity.
Coming up from New York City. More to come. Your equity market positive. This is Bloomberg.
is renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and death. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
We basically rebooted the global economy. We shut it down and turned it back on, and it's coming with a lot of messy frictions.
You've got a ways to go to get to pre-pandemic employment.
I'm against the view that we're in the roaring 20s and that we're going to leave a new era for U.S. growth. I think we're just back to normal.
We do think it's transitory, but we also have to admit that there is a very fair chance that inflation will turn out to be sticky.
If you step back and think about what's going on, it's very, very clear. We are borrowing from the future.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Getting closer to Payrolls Friday from New York City this Thursday morning. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market shifting higher by 3 points on the S&P. We advance almost 0.1%. We need to talk about IP waivers on COVID-19 vaccines down in DC. We'll do that later this hour. Tom, we've got to talk about this market too. What a fascinating moment for the bond market.
Yeah, the last hour really drove into the drugstore. We'll do that later, as John mentions. John, the market is absolutely original, and I'm going to go back to the partition you made yesterday between the financial dynamics, the inflation rate dynamics, and also the real economy dynamics. To me, the massive mystery is the real economy in September or December or say March of next year.
The D word, deceleration. In the meantime, we're confronting what in the bond market? Real yields deeper into negative territory. In the equity market, a tech story that's struggling to get a bid even with blowout numbers and a negative real yield, Tom, that's heading the other way.
I looked at the charts this morning. The standard, John, I went to the Standard & Poor's 500 instead of the Dow.
I congratulate you for that. I'm proud.
It's not even down 2%. This angst over a non-correction I really take issue with.
Tom, I'm with you. I'm not trying to make this sound dramatic. I'm trying to tell you that what's happening in the equity market on the sector side. Keep going. On the sector side, financials, energy, that's where the outperformance was yesterday. At the lower end, utilities really underperforming. And I can't reconcile that with what was happening with real yields. Real yields were heading the other way. Inflation expectations were building. The nominal was stable, and real yields were heading south.
And we got a good guest coming up on this, but it's a soup right now. It's a bouillabaisse, as the French would say.
Perfect accent.
Oh
my God.
Honestly.
It's the double L in French that will kill you.
You're killing me this morning. Never mind the French language. Lisa, your take on the market. Come on, make this serious.
All right. Honestly, the real yield issue is really interesting because basically it seems like the bond market has more faith that the Fed will come in and suppress yields or keep rates low for a longer period of time, even as equity investors look at the inflation picture and say they're not buying it. They're looking more toward the tapering. There is a dissonance here, and I wonder how much this has to do, John, with international flows. We've seen more international investors come into U.S. Treasuries due to currency dynamics and a whole host of other issues. But I wonder how much that's leading to these distortions that do not make sense. The narrative does not make sense in the market right now, John.
Just getting some headlines out of the Bank of England. The Bank of England is slowing the pace of weekly bond buying. Andy Haldane, though, voted to reduce the stock of purchases. The chief economist over at the Bank of England, now the outgoing chief economist over at the Bank of England, voting to reduce the stock of purchases. They're slowing the pace of weekly bond buying, Tom. That's the headline just coming out of Threadneedle Street this morning.
I take massive issue with them. BOE says projected inflation rise likely to be temporary. I can't have a sip of the morning beverage here if it's temporary.
Temporary, transitory.
There you go.
There you go. Have a drink,
It was a
Tom.
tragedy otherwise.
Here's the price action.
Temporary.
As if you haven't had a drink already.
Fugacious.
Futures up 3 on the S&P, up 0.1%. Yields unchanged at 156.96 on the nominal 10-year yield. In the FX market, euro dollar 120.41, up about 1/3% on that currency pair, Lisa.
Yeah, I will say today I am really interested to see the initial jobless claims at 8:30 a.m.
Yes.
And really what's curious to me is the numbers are coming down, but not that much. We're expecting a print of 538,000 new filings. Again, this number has been messy. It has been unclear. Still, how much does this indicate true slack in the labor market, people who are out of the workforce perhaps contributing to the supposed labor shortage that a lot of companies are talking about? 12 p.m., the House is going to be hearing something about GameStop and the volatility around markets having to do with Reddit traders. This is interesting to me because SEC Chair Gary Gensler came out yesterday and indicated a willingness to regulate the likes of Robinhood and Citadel more closely as a result of some of this turmoil. A lot of people watching this really closely for a lot of reasons. And 4 p.m., the Fed is going to release a document on financial stability. This is the F word of the day. That is froth. Yes, John, I'm doing this just for you. The idea that Jay Powell did recognize that there are pockets of froth in equity markets. The idea that, or not just equity markets, but elsewhere as well. He sort of discussed how they are keeping an eye on this, and Eric Rosengren pinpointing the mortgage market in particular. This, to me, could be, John, what's behind the dissonance that we're seeing in markets, with caution reigning supreme here, even as you see the bond markets very much steady as they go, and then real negative yield going even further into negative territory. The question to me is, how much are equity investors expecting the Fed to try to curtail some of this supposed froth that some people say could be in equities?
Lisa's F word for the Fed speak, froth. And not the other one that you might be thinking of this morning. Tom Keene clearly had a fantastic Cinco de Mayo yesterday evening. For many reasons, I think that's obvious this morning. Having a look at Moderna, the numbers just out, Tom. Let's go through those numbers. First quarter product sales, $1.7 billion from sales of the COVID-19 vaccine. First quarter revenue, $1.9 billion. The estimate, 2.228. Just some of the headlines coming out of Moderna this morning.
And you know, in the flow here, we've got to get to our guest here, but look at the Bank of England forecast for growth. And again, John, I'm going to go not one quarter, but extend it out. You've got an average blend off the top of my head of 6% plus for United Kingdom economic growth. That's stunning.
Yep, 7.25 for 21, 5.75 for 22. Are you just on repeat this morning?
No, I'm being fugacious.
Fugacious.
We had a viewer, Liz, call in and say that's another word for transitory.
Okay, all right. Shall I get to Daryl Cronk?
Please, he's
fugacious. Do that now. Okay, Wells Fargo Wealth and Investment Management CIO, Daryl Cronk, wondering what program he's just joined. Daryl, thank you for being with us, sir. Can we go to the market story this morning, which is deeper real yields and a slightly confusing sector composition story in the equity market? What's your read on it at the moment, Daryl?
Yeah, I think you guys are right on top of it as usual. The real yield story is the story, negative 90 basis points on real yields. Investors should not stand for negative 90 basis points of real yield. So naturally, that's going to be positive for risk assets. It's going to push money into equities. It's going to continue to push money into commodities. I mean, a year ago you had crude oil at 25, today it's 65. A year ago, lumber prices were $300. Today they're $1,500, right? So there's a huge inflation push in the economy that's not getting recognized by the bond market. If you simply just go back, John, to the global financial crisis and right after at the same time, there's a lot of comparisons that this is similar to that. You had positive 50 basis points real yield. Today you've got negative 90 basis points with a ton more fiscal stimulus, an economy that's going to come back quicker, and an output gap that's going to close faster.
I look, Daryl, at the dynamics right now, the bond market where it is. What are you telling your clients right now of how to study bonds?
So I think it's a generation that has not experienced rising yields, rising commodity prices, value stocks outperforming, right? I can go on and on with the list, right?
So you're talking about John and Lisa.
Well, not quite, but I think they've been around longer than that. But the point is, you shouldn't be surprised that you've got, technology underperforming as a long duration asset with the highest tax base, right? It has a negative correlation to rising inflation. And so when that happens, you get some of that money coming off the table. It's a growth oriented factor. So I think investors have to see the sea change that's happening right in front of them, right? It is about value over growth. It's outperformed 1,100 basis points on the Russell 1000 value over the Russell 1000 growth year to date, right? It is about commodity prices going higher. It is about a bear steepening of the yield curve. I know it's not happening today, but it's going to happen if the inflation pressures keep pushing through like we see them doing.
Daryl, you're invited back, by the way, just because you are coming to my and John's defense. There is a question, though. What happens if bonds are right? People often think of bonds as the smarter asset class. I'm sure I'll get hate mail. You can send it all here. There is this thought, though, that perhaps they're seeing something that equities are not, and that is perhaps inflation that is not rising as much. Why could that not be the case, and what happens to equities if bonds are right?
Well, if the bond market is right, then yes, you're correct. Equities would have to come down and probably reprice, right? Because you're going to catch a bid in the bond market, you're going to flatten the yield curve and drive it down. The second quarter GDP right now is tracking at 12% on a run rate for Q2. I just don't see how that's not getting reflected in. Some people are calling for peak GDP, but there is so much liquidity in the system, right? There's $2 trillion sitting on S&P balance sheets. There's $4.7 trillion sitting in money market funds, and there's almost $16 trillion in commercial bank deposits sitting out there. That money has to go somewhere. It will go somewhere, right? And that's going to continue to push inflationary pressures higher, notwithstanding supply chain pressures and everything else we talk about. So it is possible, but I still would contend the bond market actually right now is not getting it right.
Daryl, got to leave it there. Daryl Cronk, Wells Fargo Wealth and Investment Management CIO. Terminal subscribers responded to that debate. We are the smarter asset class, Lisa. You don't need to look around any corners to see that.
No, but John,
thank you. I like that a lot.
But John, what Daryl brought up there is really important. I took the Bloomberg sub-index of commodities today.
Yeah.
The agriculture index is a moonshot, up 70% plus since the beginning of April. I don't know what that signals, but there it is.
It's not just ags, it's energy too. It's base metals as well.
Fair.
All fired up, Lisa.
The idea here, though, is that the bond market, if you look at the break-even rates, they are signaling the Fed is correct, that this is transitory. Go ahead, Tom. That basically, if you look at near-term inflation rates, they are the highest that they have been going back decades relative to 10-year Treasury, 10-year rates. This is interesting. Yes, transitory.
John,
transitory.
can I rip up the script? John, is BOE, boring, boring, boring. This is not boring, is it?
I'll recap the Bank of England for you, Tom. There's a difference between cutting the pace of something and cutting the stock, the target of an asset purchase program. So they're slowing the pace, which essentially extends the duration of the program, maybe by about a month, but the overall purchase target remains the same. Andy Haldane confuses things a little bit because he had a dissenting vote today. What he would have liked to see was not just the slow of the pace, of course, but also a reduction in the overall size of the program. What the Bank of England has essentially done this morning is slowed the pace, extended the duration by keeping the stock target, the asset purchase target, precisely the same. So that's the news out of the BOE. The headline, Tom, the Bank of England thinks the UK to recover to pre-COVID levels over this year. And as we talk about a commodity market, here's another red headline across the Bloomberg for you. Iron ore, a record above $200 a ton.
What did Governor Bailey say about Manchester United and Liverpool?
I hope Francine Lacker asks that question a little bit later, Tom.
Yeah.
If she catches up with the governor.
First question.
Clearly.
Really important.
Vital. 8 a.m. Alan Ruskin at
We're
Deutsche
on top
Bank.
of the news here.
A little bit
Value
later,
add.
8:30. Mr. Stiglitz, Professor Stiglitz, Nobel laureate. Looking forward to that chat too.
We'll ask him about me and you.
Equities up 5 points. We advance 0.1%. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden says he's open to compromise on raising the corporate tax rate. The president has called on Congress to boost the rate from 21% to 28%, but he now says he doesn't have to be exactly what he says. Democratic Senator Joe Manchin has said he could support a 25% corporate rate. The U.S. will support a proposal to waive intellectual property protections for coronavirus vaccines. U.S. Trade Representative Catherine Tai told Bloomberg the U.S. wants better access, more manufacturing, and more shots in arms. Drug makers are opposed. They say few countries have the capacity to make the vaccines, even if they knew the formulas. And there's a change at the top of AB InBev. Carlos Brito is stepping down as CEO after 32 years at the beer maker. He'll be replaced by the head of AB InBev's North American operations, Michelle Dockeris. This comes after the company posted a blowout quarter. And SpaceX nailed the landing in the 5th test of its Starship rocket after reaching an altitude of about 6 miles. The rocket made a controlled descent to its launch pad in Texas. SpaceX founder Elon Musk sees the rocket as a future workhorse for trips to the moon and Mars. NASA recently picked SpaceX to develop a moon landing system with Starship. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Be
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
I'm open to compromising, yes. It doesn't have to be exactly what I say, but to suggest that, which some of the folks are suggesting, and I'm going to meet with Republicans next week when they come back, and seriously meet with them. I'm willing to compromise, but I'm not willing to not pay for what we're talking about. I'm not willing to deficit spend.
I love that line that you had to throw in there. Seriously meeting with them. Take it seriously. It's not just for optics. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action. Your equity market up 5-6 points on the S&P. We advance a little more than 1/10%. Commodities, the story at the moment, 65.29 on WTI. WTI down on the session, up on the year by almost 60%. We've got Brent approaching 70. Copper breached 10K recently in the last week or so. Year to date, I think it's up almost 30%. Lumber futures topping 1,500 for the first time ever, Tom, was a headline that dropped earlier this week too. And now spot iron ore climbing to a record above $200 a ton on this massive boom we're seeing, this huge demand shock working its way through a tight commodity market at the moment.
And John, I go back to what you've always emphasized, and I think it is the British heritage, seriously, folks, as John focuses on Australian dollar and Australian boom economy. I noticed, I believe it was yesterday, John, Australia with some strong economic statistics.
Clearly,
as well.
The commodity currencies will take advantage of this, Tom.
Look at Canada, 122.
There is a real conversation, isn't there, about inflation that the Fed's not having. From a market's perspective, I'm trying to work out whether the hedge, which is the commodity story, the hedge, which is energy in equities, and I use that word carefully, the hedge becomes a conviction call, becomes a conviction trade. Whether this is just a hedge in tips, etc., and it becomes a conviction call in a bigger way.
And just shout out to Jeffrey Curry of Goldman Sachs, who's just nailed this call. I mean, he's just, he took a swing at it and said, we're going to go higher, and he did that. Just because of time, let's get right to it. With Jack Fitzpatrick, there's 14 things to talk about of his Washington, including the brawl last night between the Washington Capitals and the New York Rangers. We'll skip that. Jack, I want to go to the unspoken, which is all the first 100 days, malarkey of people like you. How have the first 100 days of Citizen Trump gone?
Of Citizen Trump, not well. I mean, we're seeing a ton of statements from him that he would probably like to put on Facebook and Twitter that he can't and won't be able to for at least the foreseeable future, depending on how things go in the next 6 months on Facebook. But he is pretty much in control of the Republican Party still, and we're seeing that in the fight between Liz Cheney and now Elise Stefanik, who could replace her in a House Republican leadership position. So Trump is still Trump within the Republican Party. He's still really the leader of the party, effectively. But clearly doesn't seem particularly happy with developments on social media.
Let's get out front of the story. How will he and his Republican Party respond to the patent uproar that we see from President Biden?
The Republicans typically are pretty skeptical about the patent vaccine waiver issue. There have been complaints from the pharmaceutical producers. I'm not sure exactly how Trump is going to drive that. Right now, Republicans are the minority party, and a lot of the power on this decision is in the hands of Biden and the Democrats. And there was a push from the progressives, from Sanders and Warren and those types, to get this waiver. So I'm not sure that's going to be a major campaign issue going forward. They've got a lot of other stuff on their plates. So that may not quite be on Trump's radar as much as immigration and the economy and that kind of thing.
I want to dovetail the vaccine issue and the IP waivers with what John started the conversation on, talking about commodities. There was a story in the Financial Times talking about how India accounts for nearly 1/3 of all seafarers, of all of the crew members of shipping cargo ships. The idea here being that this could further disrupt some of the obstacles that we have seen in the supply chains based on the crisis that's ongoing in India. How much is Joe Biden, looking at the infrastructure, at supply chains as a national security issue, at trying to get sort of stop to the pandemic in India and other nations in order to protect that for the United States?
You know, they actually haven't been entirely clear on the reasoning because there are so many reasons to be concerned about India and other countries that are struggling with this. That may be a significant reason for the Biden administration, but ultimately the supply chain concerns, the concerns over variants developing in other countries that could eventually come back here where the vaccines are less effective, and also the moral push from progressives especially to help other countries and also to put the U.S. in a more of a worldwide leadership position, the way Biden has proposed, are really all seemingly driving this. So I'm not sure I can give you a ranking of where that falls into it because it's really kind of being presented by the Biden administration as a holistic reasoning for the vaccine waiver. But that is a significant issue, obviously.
Jack, I think we have to be really careful with the language we use around this conversation. One thing the left has done has monopolized the moral high ground with a single perspective. And what it does not allow people to ask legitimate questions. And I think the starting position is not that the Democrats want to help low and middle income countries and the conservatives, the Republicans do not. I don't see that. It's about how you help those countries. And that's the debate we need to have on a program like this. And when I hear you say things like Senator Warren would like the waiver for IP, I think the worry that people have is that Senator Warren doesn't want it to stop there. She wants it to go further. Isn't that the real debate down in DC at the moment, that the freedoms people have lost, the freedom of movement, the freedom of speech, arguably, which is an argument going on down in DC at the moment. And if then we get into property rights, does it stop there, just in the crisis, or does it go further? Isn't that the ultimate concern right now?
That is not necessarily the immediate concern, but the ultimate concern. I think you could make potentially a pretty persuasive slippery slope argument about how far this goes and what the effect would be potentially on vaccine production for who knows if this is even going to be the last pandemic that I lived through. We don't know when the next time we're going to have such a worldwide effort to ramp up production of vaccines. So the long-term concerns are there. And when I say the moral arguments that have won the Biden administration over, to be clear, these are moral arguments, but they're not the only moral arguments involved in this. So that has been so far the winning moral argument in terms of winning over the Biden administration, which is in control of this. But it does raise a lot of questions going forward for the long term. But really, a lot of the conversation in Washington is more on the immediate threats. Even though there are concerns that mostly are being expressed on the right, a lot of, especially when you hear the Biden administration, a lot of the rhetoric around this is how to produce this vaccine right now as quickly as possible.
Yep. Jack, it's great to catch up. Jack Fitzpatrick there of Bloomberg Government. And Tom, that's the issue at play, isn't it? We need to help these countries. How do we do it quickly? And if you suspend the IP protection, do you get to do it quickly?
Well, quickly is the quickly, and how long is quickly? I don't see how we do it at a speed that India needs, is one example.
From New York City this morning, good morning. This is Bloomberg Surveillance with futures up 0.1%.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City for our audience worldwide, this is Bloomberg Surveillance Live on TV and radio. Tom Keene's got it in his head that he needs to do something about the ratings of this program. I tell you what, Tom, if we could take the commercial break live, the ratings would go through the roof. Equity futures right now on the S&P 500, 41.64.
No, none of us would want that.
Up about 1/10%. On the Russell, we're up about 1/3. On the NASDAQ,
Dow quote.
up about 0.16.
Dow up 42 points.
Thanks for that, Tom. I tend to skip it, but I'm pleased you tend to do it for us as well. Switch up the board and get to this. I'm looking at this chart this morning. Take something growthy, copper, and compare it to something defensive, gold. It's the copper-gold ratio. And that's been breaking out again recently, and this is what Chris Verona, Strategas, is looking at too. So if you take the equity market, energy doing nicely, banks outperforming, tech underperforming, feels like a growthy story, doesn't it? A cyclical pickup. You see that in this ratio too. Where you don't see it though, more recently at least, is in the bond market. So let's finish on this. 2s, 10s, 30s in treasuries. Yields right now unchanged at 157. Your 30 at 225. Up almost a basis point or so. So what's going on? And how do we reconcile the tension? And Tom, Chris Verone has the call. Chris thinks, actually, elsewhere's right and yields need to break out higher again. We've settled down and we're primed now for another move higher. That's just one of the calls out there, Tom. There will be others too.
Yeah, my observation, John, is your wonderful chart for radio. The chart is copper versus gold. And I love, John, how you use Chicago copper there. You don't use LME copper there. It's good that you use Chicago copper this time around.
I appreciate that. I do that because I didn't use the Dow, Tom. That was just for you.
HG, it's chemistry, like Morrison and Boyd. HG.
I see it. I know. I understand.
HG.
Okay, we're done with this. I feel like we're done with it.
We're way done.
I feel like we're done on a series of front seats.
I was done like an hour and 31 minutes ago.
Morning, Romain.
All right, we're going to keep the ratings going here. Let's take a look at some of the movers here in the pre-market. Hey, look, guys, you've been talking about this a little bit earlier here, but obviously this decision by the Biden administration to back this waiver at the WTO, having a little bit of a knee-jerk reaction here in the pre-market. You're seeing Pfizer shares down about 3%, around 38.76. But it's interesting, when you look at some of the sell-side commentary here, they really talk about this idea of diversification. And you talk about a company like Pfizer, which is well diversified. It has certainly gotten a big benefit here from the COVID vaccine. But this is really going to amount to a speed bump at best for Pfizer, and that's assuming that this waiver actually goes through. A lot of analysts actually don't think it's even going to make it to the end of the pipeline here. But then you take a look at a company like Moderna. This is a company that came out with earnings this morning, reporting about $1.9 billion in sales. Almost all of that, about 1.76 or so, is from the COVID vaccine. So this is a big deal for a company like Moderna. Not only because they're making most of their money right now off the COVID vaccine, but keep in mind, a lot of the technology that's baked into that COVID vaccine, they're using that same technology, that RNA technology, for the rest of their products in the pipeline. And there is a lot of concern here that if this waiver does go through, what does that do to some of these other drugs that the company has in development, drugs that really have nothing to do, at least directly, with the COVID vaccine, with the COVID crisis here? That's having an effect on BioNTech, CureVax, and Novavax, and a lot of other companies that are also in this same boat. This technology really goes well beyond just treating COVID crisis here, and the longer-term implications could be really massive for a company like Moderna. Flip up the board. A couple other names to keep an eye on here in the pre-market that have been moving. We did get earnings last night from rocket companies. They were awful. Those shares down 14% here in the pre-market. Loan origination volume dropped by about 3.5%, down to about $103 billion. And the company's saying that next quarter, that's going to be down to about 87 to 82.
And Romaine, this goes back to
billion.
what we heard from the banks. I mean, loan demand is not there.
And this is a big issue because we know how resilient it's been, and there's been everyone's basically said, look, the cliff is coming. This can't last forever. Now, whether rocket companies is symptomatic of what's going on in the broader space, or whether this is just about rocket companies, who knows? But the expectations were high here for this company. They're high for a lot of other companies in this space, and right now it doesn't seem like they're going to be meeting it. So let's see if that feeds in to the home builders. Let's see if that feeds in to something like lumber prices. Who knows? It could take a while for that to trickle through, but keep an eye on those names. And just real quickly here, PayPal did actually report a very good volume growth, up about 50%. Those shares up 5% pre-market. Fastly going in the opposite direction. Big beneficiary of the COVID crisis, down 18% here in the pre-market.
Romaine Bostick, thank you so much to close this afternoon. Right now, and this is really, really an important moment, David Stubbs joins us with JP Morgan Private Bank with a view on what you should be doing in the equity markets. Our theme today is clearly the oddities of bonds and equities. And David, I'm going to go to one single sentence within your important report. We expect growth to stay strong. To me, this is the money debate right now. Do we get persistent, buoyant economic growth into next year or not? Discuss that, how you fold in Bruce Kasman's work in economics into what you do at Private Bank.
Absolutely. Great to be with you, Tom. Look, I think we need to not confuse a peaking in growth momentum with an end to very powerful growth. And certainly a lot of cyclical indicators out there are at very strong levels. But that doesn't mean that we're not going to get a tremendous impulse from both the real and nominal economy throughout the next few quarters. You see that with central banks upgrading their growth forecast. Bank of England just did it right now. And as Bruce's team has pointed out very clearly, we see significant upgrades coming through in countries which are getting their vaccine rollout done properly. We see central banks determined to lag the recovery. We see impressive fiscal policy support as well. And you put those three things together, it all adds up to tremendous earnings growth, which means we believe the equity market can make new highs despite being obviously very buoyant in the last few months.
So, David, what are tens doing south of 160 in the Treasury market?
Sure. I think firstly, momentum and being overstretched works in the bond market as well as the equity market. You had one of the worst quarters in fixed income of all time in the first quarter. You've also had, I think, a lot of foreign buying, especially from the Japanese, given the hedge yield is now quite attractive, and they just rolled over into new financial year, which often drives some flows there as well. But we would agree with the fact that it's not going to stay here for long. We have a target of around 2% about 12 months from now. It'll be a bumpy ride up there for sure. But absolutely, we believe that both the yields are going to rise and curves are going to steepen. One of the reasons that we absolutely do like some of the cyclical plays, including financials.
Just to build on that, where does the growth picture fit into this? And I don't mean the cyclical growth, I mean growth equities, David, because what we've seen play out over the last week or so, real yields further into negative territory, and tech has not been the outperformer in the way that some people might imagine. Why do you think that is?
John, I think firstly, tech is a massive overweight in a lot of portfolios. Almost every portfolio I see across private banking clients around the world has a lot of those mega cap tech names. So I think this is not a place for incremental capital to go for a lot of people. That's a first place. I think also there is a question mark over regulation in the US. We are fairly sanguine on that because we've done a sum of the parts model, and we believe absolutely, even in an extreme scenario where they start to talk about breaking up these companies, we still see some value there. And also I think that it's just so clear to people that we are now sustainably exiting this pandemic. The US and the UK are leading the way. Europe is going to be swimming in vaccines in the third quarter. That story is still very much ahead of us. A lot of that points to some of the best opportunities on a tactical basis not being in mega cap tech, even though we still like it for the future for sure.
There's a question about commodities as well. We've been talking about the incredible rally that's causing certain assets to surge to record highs. We've seen the best start to the year in a very long time, possibly in records going back to 1970, depending on what index you use. Given that, where do you see the potential opportunities? Because I know that in your recent research, you said you're starting to be selective.
Yes, absolutely. I think that firstly, if you buy broad commodities, you're often taking things which are seen as defensive. As John started the show with, copper over gold. If you buy like a broad basket of commodities, you're getting some of the gold as well. We absolutely are positive on industrial metals. They've done well. We think they can do further based on tight inventories and a range of secular forces which should power them beyond this cyclical upswing. And I think energy is also a really interesting play with the confluence of restricted and disciplined supply now, a focus on yield and shareholder return by the mega caps in the positive column, but also in the negative column, of course, a transition to a sustainable economy and the potential for very significant investment being needed if these companies are going to survive in a clean energy world. I think that's why investors are rightly skeptical of some of those companies. So bottom line, we want to be selective into industrial metals. We just released a new paper on copper and all the fundamentals there. And there were some pure plays in the equity market on the copper side that we would absolutely be recommending clients take exposure to. But we don't just want to buy the whole thing.
On the flip side, how much do these rising industrial metal prices weigh on certain sectors in U.S. equities and companies that are trying to offset the increases in input costs by hiking prices for clients?
I think one of the huge trends going forward in the next 6 to 12 months is focusing on companies which do have pricing power, because we do see a lot of increases in input prices. And we know that for key sectors, there is scope for margins to contract if they cannot pass on those price increases. We still think that when you look at some of the damage to the labour market around the world, we don't foresee a huge upswing in end price consumer inflation, because we do see a range of both cyclical drags from that damage, at least for the next year or two, plus the secular deflationary forces we've been discussing endlessly on this program for years around globalization and around those supply chains. So absolutely, we want to transition to the kind of handful, the limited number of companies potentially that are going to be able to pass on those costs. We do expect margins in some areas to be under pressure.
Great to catch up, David. As always, good to hear from you. David Stubbs there, JP Morgan Private Bank Global Head of Market Strategy. Tom, right now, isn't that the debate at the moment for the cyclical trade? A lot of people still believe this has got a long way to run. You see it in the commodity market. It's a demand shock that has only just started.
It's what keeps us going as we go into claims here in less than an hour, and also into jobs day tomorrow. I'm sorry, it comes back to the real economy guesstimate. We don't have a crystal ball, and boy, guess to guess, this is a heated debate.
Yep, going into payrolls Friday, Lisa, looking for some big numbers.
Yeah, the question is to me about the labor shortage and how much that actually exists and why. And that, frankly, is a huge tension as more and more companies complain of not being able to hire workers fast enough, with the number perhaps representing that labor market willingness to come back online, John.
And that labor shortage issue, you just see that in the ISM, the PMIs, every single data point, every single...
Yeah, but is it just
raise prices, raise wages.
Is it solved by the social programs? People aren't working because they're getting paid by the government.
And the governor of Montana, a Republican, has implied exactly that.
It's nuanced. The data is mixed on that.
It is always more complicated than a conversation as short as the one we're having right now. Coming up, 8:30. Joseph Stiglitz, Nobel laureate and Columbia Business School professor. I think he's going to have an opinion on a couple of things. Futures up 2 on the S&P. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden says a corporate tax hike doesn't have to be exactly as much as he wants. The president indicated he's willing to compromise on one of the key features of his infrastructure and jobs proposal. Democratic Senator Joe Manchin says he can't go for the president's proposed increase from 21% to 28%, but he could support a 25% corporate rate. And Treasury Secretary Janet Yellen faces the challenge of getting a debt ceiling increase through Congress without shaking investor confidence. The current suspension of the U.S. borrowing limit expires August the 1st. The Treasury Department warns that if Congress doesn't act, the administration would have to shift federal funding to make good on debt payments. And China is suspending a regular economic dialogue with Australia. It's a mostly symbolic move meant to signal Beijing's growing frustration. China curbed imports from Australia after efforts by the Australian government to restrict access by Huawei technologies. Last month, Australia cancelled agreements between the state of Victoria and China's Belt and Road Initiative. In France, Société Générale has turned in its best equities trading performance since 2015. Revenue at the unit surged in the first quarter after being wiped out a year ago. Those results provide some relief for the SocGen CEO. He's preparing to update his strategy for the investment bank. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Fed that's extremely friendly. They tell you they're going to keep interest rates low, not only this year, but we're going to keep them low next year. I'm assuming they're going to be surprised by inflation. It's going to be more intractable, and the market's going to be surprised that the Fed will raise rates sometime in 2022. They'll be forced by inflation.
Leon Cooperman there of the Amiga family office, the chairman and CEO on inflation and what it could mean for rates and ultimately this market. From New York City this morning, good morning. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. Here's the price action at the moment. We shape up as follows on the S&P 500. Futures positive 3, up almost 0.1%. Yields up almost a basis point, 157.49 on 10s. Euro dollar 120.49, up about 0.4%. Euro stronger there. Crude just a little bit lower. Commodity rally defining the moment we're in at the moment. Demand shock, 65.30 on WTI, down 0.5%. Here's a line from JP Morgan and Marko Kolanovic. Take a listen to this. Many of today's investment managements have never experienced a rise in yields, commodities, value stocks, or inflation in any meaningful way. He concludes that portfolio managers likely will not take chances and will reposition portfolios. And Tom, arguably, that's what we've been looking at.
Absolutely, and it all moving along here in real time, and we'll continue this. Claims coming up here in about 35 minutes. What John and I like to do is stop the show when it's important, and right now it's important, and we are most fortunate to have David Wilson with us, our Bloomberg Stocks editor. One of the giants of what we do has died, and died tragically young. David Swensen was at Yale. He's the one you don't know. You know John Bogle of Vanguard. You know Peter Lynch. You know Warren Buffett. Great. David Swensen was the giant that they worshipped. And David Wilson joins us now. John and Lisa, I want you to come in on this as well. Modern portfolio theory, Swensen learned it from James Tobin, and he said, wait a minute, there's a better way to do that. And David, that was the Yale model.
Yeah, absolutely. And it changed the way that endowments across the country were invested. The whole idea of not just focusing in on, publicly traded stocks and bonds, broadening investment horizons, private equity, that sort of thing. I mean, and that's why the Yale endowment has done as well as it has over the decades.
I sat on the stage at Darden at University of Virginia with people that worship Swensen. And at that time, this was UVA, had hit a home run only because they diversified into commodities. And David, we're there right now again with a commodity moonshot.
Yeah, absolutely. And now people are starting to pay attention to an area of investing which, frankly, hasn't gotten a lot of love over the years, and understandably so, because it's really only in the past year or so that we've seen commodities pick up.
And John, this goes right over to London and the city as well. David Swensen was absolutely iconic in shifting how we think about the word that Peter Lynch spoke so much of, diversification as well. It folded over in endowments. And, John, the one that I really would want to talk to right now is Mohammed El-Arian, because he confronted this and the challenges of Harvard endowment years ago.
Well, let's go through the statement from Yale University, Tom. Dear members of the Yale community, I write with profound sadness to share the news that David Swensen, Yale's chief investment officer, died yesterday after a long and courageous battle with cancer. David served our university with distinction. He was an exceptional colleague, a dear friend, and a beloved mentor to many in our community. Future generations will benefit from his dedication, brilliance, and Tom, his generosity as well.
David Wilson, from where you sit, has the endowment model been blown up with all of the hedge fund alternative? Forget about Archegos and that. It used to be simple. Robert Kirby at Capital Guardian Trust would say, you know what, you need to make 2 percentage points over the bogey. That was it. John Bogle at Vanguard blew that up, and Swensen said, no, we can still add value. Did he?
Oh, he surely did. I mean, why is it that there are so many endowment managers that, in essence, owe their strategy to Swensen's approach? I mean, it's clear that he had something that other people sought to emulate. I mean, another piece of the puzzle, perhaps, is that, as an individual investor, it's easier now to go the route that Swensen did, if only because there are so many, alternative investments that are being packaged into things like exchange-traded funds.
That's the key here, John. This is really important. Lisa, jump in here as well. This phrase package, which David just nailed. John, we become a consulted businesses. What David Swensen said is forget about the consultancy, diversify, and get the job done.
This business, Lisa, has changed, and it's got a whole lot harder.
And there's a question here about the amount of money that's been flowing into private equity and hedge funds, which really hinged off of the Yale model, the idea you need to go further into risk and other asset classes in order to get the returns that you need to meet your obligations. President Dave Wilson, there is a question here about whether this works after such a long period of time of doing this, of so many foundations doing this. I mean, how much are you seeing an ongoing shift in this direction versus just going all in on equities, since that's been a good bet?
Yeah, I mean, that is a reasonable question because, like with any strategy, if you're sort of the first mover, you have an advantage. And if you're kind of playing follow the leader, which undoubtedly a lot of endowment managers are, I mean, it's a real question as to whether you can gain that same advantage or anything close to it.
That's right where I want to go. John Farrell, this is so important. You and I have discussed this over the years. I think CalPERS has been really articulate about this. David Swensen did this with smaller amounts of money. Granted, it was billions, but it was smaller amounts of money. And John Farrell right now with Apple, with Amazon, with the mass of the S&P 500, how do you move the value and how do you move the needle and add value in endowments versus doing what Bogle did, which is just buy the index?
Well, Tom, I think what you're getting at is where do you find your edge? Where do you find your edge when 5 big companies, a handful of companies make up so much of the overall index and they're so well researched? And we've asked that question a million times on this program. And what's been the response? Small caps, mid caps, the under-researched names, Tom.
And what was so great here, David Wilson, and this goes back to Mike Bloomberg as well, is Swensen. I don't think a lot of people know this. He was on Wall Street at Salomon Brothers for a cup of coffee. He was 31 when he took over responsibility at Yale.
Yeah, and he had certainly a lot of time to implement his ideas about investing.
And make mistakes.
Yeah, and a lot of money managers don't get that opportunity. If they can't keep up with their peers, they get bounced.
30 seconds. Give me a view of what you're looking at within your charts and within the markets today.
Well, just in terms of today's chart that I'm focusing on, it was one I picked up yesterday on Twitter from Julian Brigden.
You stole it from Julian Brigden.
I didn't steal it. I gave credit to him. He's at
we call that stealing.
Well,
Continue.
call it what you will, but it's interesting because if you look at ARK's flagship fund, ARK Innovation, it turns out it pretty much tracks a Goldman Sachs index of money-losing companies. And that's just not just, that's more than just looking at the lines. I actually ran a 30-day correlation. You've got numbers 0.68 to 0.98. One means two things are moving in tandem.
That's rude. We don't do correlations until 9 a.m. Okay? Farrow does it a little bit on his property at 9 a.m.
Well,
Tom, John, correlations at this hour?
He's allowed. It's David Wilson. He's allowed.
I'm the new kid on the show. What do I know?
Dave, thank you for waking up so early for us. Dave Wilson there.
Brilliant
our
there,
stocks
David
editor.
Swensen.
On the news at the moment, Tom, Yale University writing with profound sadness to share the news that David Swensen, Yale's chief investment officer, died yesterday evening after a long and courageous battle with cancer.
He was worshipped.
Coming up on the program, Alan Ruskin, Deutsche Bank Chief International Strategist from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Your equity market looks like this, up 1/10% on the S&P 500. We advance 4 points. In the bond market, yields are higher by almost a basis point, 157.32, euro dollar 120.53. This is Bloomberg.
One of the interesting features about this illness is that if you look at it, the people who develop these long haul symptoms are often not the individuals who are hospitalized and were sick and on a ventilator and stuff like that. These are individuals who actually, most often, they never went to the hospital. They had a relatively mild illness in the acute phase, and they recovered from it. if you were in the hospital, means you probably mounted a very strong immune response, okay? And you recovered from the illness, you probably got rid of the virus. If you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, oh, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of your life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is going to touch.
Friday is Jobs Day on Bloomberg Television. Will unemployment move lower, and how will markets react? Plus, special guest, Minneapolis Fed President Neel Kashkari. The April Jobs Report, Friday morning on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center.
To tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
We're also seeing a really strong recovery.
No one delivers the data faster.
Nestle's out with numbers. Can this company continue at this kind of clip?
Bloomberg Television, your home for earnings season.
We basically rebooted the global economy. We shut it down and turned it back on, and it's coming with a lot of messy frictions.
I'm against the view that we're in the roaring 20s and that we're going to leave a new era for U.S. growth. I think we're just back to normal.
We should all recognize that the economy right now is experiencing a demand shock, the likes of which we haven't seen since World War II.
The last thing in the world I really care about is that wages are going to explode. They are not.
If you step back and think about what's going on, it's very, very clear. We are borrowing from the future.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thank you for joining us on radio, on television, a simulcast here on economics, finance, and investment, and the American labor economy. John, in this hour, we see what a boom economy really employs.
I think Charles Cantor absolutely nailed it over at Neuberger Berman. We are facing a demand shock. 12 months ago, in the month of March, we faced a negative demand shock like the world has never seen before. And this time around, we face a positive demand shock like the world has never seen before. And you see it picked up in the commodity market. You see it picked up in the labor market. And a big question we've started asking, and it will be the question we ask for the next several months and maybe the next several quarters too, is how the supply side of the economy responds to that.
Well, not only the microeconomics of it, John, but just look at the Bloomberg, and we see the oddest of markets right now, John. I think you're right to go to your property, see it Friday afternoons. The real yield, I'm going to round it to negative 0.90. That stuns the bulls and the bears.
And that's rolled over. That's rolled over, yet you have not seen what you'd expect to see maybe in the equity market, which is some real support, some real fuel maybe for the tech trade. What you have seen is the cyclical trade, energy pickup, the reflation trade pickup. You've seen that in commodities too, whether it's lumber, soft commodities, ags, whether it's metals, whether it's energy, just big rallies year to date.
Lisa, with your reading, your observation on the American labor economy, we're 28 minutes away from the clarity of claims.
I want to dovetail the idea of the labor market shortage with inflation. This question of will we get wage inflation, we've been talking about that for weeks, but is that at the heart of these labor shortages that these companies talk about, that they're just not offering high enough wages, or is there something else, some other friction, whether it's parents who are with their kids who are out of school or some other influence here? But this friction that is not understood is at the heart of the inflation debate, Tom.
Yeah, my answer, send them away to camp for 14 weeks. That's under consideration.
Yeah, that's
right
inflation.
Now. John, before we get to the data
that?
and our guest, I really want to talk about the deepest market, which is the full faith and credit of the United States dollar. There's a lot of different nuances out there.
Yeah, there is. If the cyclical trade picks up in a bigger way, in a more synchronized fashion, Europe joins in, we're seeing that. Asia joins in, EM in a bigger way, you'd expect some real dollar weakness. Euro dollar right now, 120.55. We saw it threaten to break out through 121. Well, we've rolled over again, Tom. I know we're positive on the session, but just in and around 120 is where we've been for much of the past week.
I'm looking at the Trudeau Canada through to a 122, 125, 43, 122, showing that commodity boom. John, the boom in the data market here as we go into claims to me is equities. You know, I know it's terrible. Amazon, Crater, da-da-da-da-da. We're down 1%, SPX.
Tom, financials have carried on rallying.
Yes.
Energy's carried on rallying. It's the financials that I'm struggling with. The yield curve is not as steep as it was. In fact, it's moved the other way. Real yields have not been breaking out. They've been moving the other way. Yet financials have been picking up in the face of a very, very patient Federal Reserve. That trade's continued. Why? I think we need to talk about that a little bit more.
Let's do it right now. Alan Ruskin joins us on Foreign Exchange with Deutsche Bank and their chief international strategist. Alan, you go right to the heart of the matter, which is the price of the many worries that we have out there. How will the dollar respond to this set of 2021 worries?
It all depends really on how the market adjusts its expectations as far as the Fed's concerned. Right now, you know, the Fed is giving the most dovish message you could possibly expect. That's about as dollar negative as you would anticipate at this point in the cycle. The question, I think, is, you know, does the tapering debate advance at all? It's clear that Powell squashed that debate for the time being through to June at least. But I suspect that when we start talking about tapering, the dollar will get a little bit of temporary support. The longer-term story for the dollar looks more negative than I've seen in a long time, however. So this short-term story that relates to the Federal Reserve and a longer-term story that relates to imbalances, notably what happens to the current account.
Can we talk about a cyclical trade more broadly, globally, Alan? I've been surprised that euro dollar has been pinned down to in and around 120. I know we were threatening a 116 handle only a month or so ago, but to get to 120.57, that rally just seems to have stalled. And the picture's pretty clear from here, Alan. Things look better in Europe. The vaccination rollout looks better. This could be a good summer for the European economy. I think we all hope it will be. But right now, euro dollar at 120.56. I think some people are scratching their heads, Alan, why this rally has stalled.
Yeah, I think the problem you have in the foreign exchange market is we love movements in short-term rates in particular, and we're not going to get that. We are getting some movements in terms of central banks and central bank expectations, mostly revolving around retreat from quantitative easing. So the tapering story that you saw from the Bank of England today is, you know, is obviously an interesting one. But you're not getting movements and are not expected to get movements in terms of short-term interest rates from all these major central banks for a long time to come. So it's hard for, you know, the growth data, for example, to move the needle as far as ECB expectations are concerned, as far as Fed expectations are concerned. And I think that's containing foreign exchange volatility for the time being.
For the time being, in the near term, you're sort of clarifying all of your statements on the dollar. Longer term, you have a more negative view. What will be the tipping point that will shift a perhaps benign environment to one that's more pernicious for dollar?
Yeah, I mean, it's a great question. I think if the Fed seems to take on board the stronger inflation data that's coming down the pike and bats it aside effectively, you know, is true to its word and says, you know what, we still think this is temporary. And if the market does not believe them, then I think you're in a space there, which I think is potentially dollar negative. And I think there's every reason for the market not to believe the Fed if you do actually get inflation expectations and inflation itself actually rising, because we haven't seen these kinds of circumstances as far as inflation's concerned, it's certainly in the last 4 decades.
Alan Ruskin, let's wander back to Cape Town that you know so well. Let's take USD ZAR. Let's look at emerging markets. Let's look at the commodity opportunity that's out there, or has it already been had? South African Rand 18 to a 14.
Yeah, I think, there's a lot of good news that's being priced into commodity currencies. I think there's further run. I think what you're seeing in the FX market is a tendency to run with the G10 commodity currencies. They feel that EM has, got its own special story. Not least it's lagging as it relates to vaccinations, of which South Africa is obviously part of that. So I think the opportunities that have been seized on have been mostly 3 currencies, I would say, Canada, and Norway and Australia, of which the first 2 have tended to perform very nicely. Aussies tending to lag a little bit.
Well, let's think about the last commodity cycle and where things like dollar Brazil were back then. We were looking at a 2-handle. Back then, Alan, we're looking at what now? 536, 533. We've had a move off the back of another hike over at the Central Bank of Brazil. Is that where you would look for the next leg of this trade to develop, Alan, in the commodity-sensitive parts of EM?
I'm still cautious in that space. As mentioned earlier, I still think that you need to see the vaccination story generating the kind of opening and growth outlook that in turn instills some central bank tightening. That would be the kind of ideal environment to look for. So, look, I think if you look at, for example, yesterday or the most recent PMI data, you have G10 countries on average with PMIs above 60, and you have EM countries, GDP weighted, at around 52. So there's this huge gap here that's developed, and I think we need a closure of that gap in terms of growth outlook before I'd really be gung-ho on the EM commodity currency side.
Alan, is there anywhere within the commodity currency side that has not accurately priced in some of the demand that we're seeing on the infrastructure spending, et cetera, side of things?
Look, I think this is just an ongoing story. So I think, those who've been optimistic in terms of growth and have been optimistic in terms of the reflation story have definitely been on side in terms of commodities. I think the tougher angle has been really to translate that into the currency side. But I think there's probably more run on the commodity side, given that we're very early into this growth cycle. We're only really going to see the true acceleration occurring in the second half of the year, led by the US. And I think a lot of other economies will follow suit thereafter. So one presumes that commodities are not at the peak of their cycle, and therefore, there will still be some pull, as it were, for commodity currencies.
Alan, good to see you. Alan Ruskin there, Deutsche Bank Chief International Strategist. Let's just work our way through the numbers in commodities right now. Lumber futures topped 1,500 for the first time ever. Brent's approaching 70. WTI is up on the year by almost 60%. Copper breached 10K in the last week. I think we're up 28, almost 30% year to date on a copper contract over in London too. And then I get a message from a terminal subscriber, Tom, that said, we haven't even started to move yet. Come on. On the FX side, that's the argument. That's what Alan's getting at here. We haven't even started to see the dollar weakness from the big sync-up in cyclical growth that we might see later this year.
Our job here, John, is not to have an opinion, but to show the magnitude and gradations that are out there. And what Alan's alluding to, which I think is frankly, probably he can say it where Saravellis of Deutsche Bank can't, is a Steve Roach-like move in dollar weakness. Roach was criticized and made fun of for that. But the fact is some of these house strategists are starting to frame up tangible dollar weakness.
More than that, in the commodity market, the commodity bulls are making this argument. Just because of the nature of the market, you can't price in the full demand shock ex ante. What that ultimately means, Lisa, is if we have a demand shock and tighter supply later this year, you can't price that in yet. And what you will see, and that's the Goldman argument over at Jeff Curry, that's why he's thinking perhaps a move to 80 on crude.
The other side of that, though, just to present the other argument, is that all of the suppliers are ramping up production, and that will come online just as the demand shock, the actual increase in demand shock, increases, or decreases rather, later in the year when people get back to normal.
Coming up, Congressman Warren Davidson from Ohio, from New York City this morning. Good morning. Equity futures 4160, unchanged. Lisa Bramwitz, Tom Keene, Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. President Biden says he's open to compromise on raising the corporate tax rate. The president has called on Congress to boost the rate from 21% to 28%, but he now says it doesn't have to be exactly what he says. Democratic Senator Joe Manchin has said he could support a 25% corporate rate. And the U.S. will support a proposal to waive intellectual property protections for coronavirus vaccines. U.S. Trade Representative Catherine Tai told Bloomberg the U.S. wants better access, more manufacturing, and more shots in arms. Drug makers are opposed. They say few countries have the capacity to make the vaccines, even if they knew the formulas. And China is firing back at the West. It urged the group of 7 to stay out of its business and fix their own problems. That's after the G7 foreign ministers unified behind a litany of grievances against China, amongst them Beijing's treatment of ethnic and religious minorities. And SpaceX nailed the landing in the 5th test of its Starship rocket. After reaching an altitude of about 6 miles, the rocket made a controlled descent to its launch pad in Texas. SpaceX founder Elon Musk says the rocket has a future workhorse for trips to the moon and Mars. NASA recently picked SpaceX to develop a moon landing system with Starship. And the chief investment officer of Yale University has died. The school says that David Swenson died after a long battle with cancer. He helped revolutionize how college endowments are managed. Swenson ran the Yale Fund for more than 3 decades. During that time, he diversified it into private equity and hedge funds and produced superior returns. David Swenson was 67. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Many people are anxious to start spending again and spending in a way that they don't have to be socially distanced. So there's likely to be a surge in demand at the same time that there are going to continue to be supply constraints. And that's going to push up inflation for this year, but we're not expecting that to persist into next year.
That captures the Federal Reserve position right now. That was Eric Rosengren, the Boston Fed president. From New York City this morning, good morning. Alongside Tom Keene, Elisa Abramowitz, I'm Jonathan Ferro. Here's the price action of the moment. This Thursday morning, going into initial jobless claims, 12 minutes away. Equities unchanged on the S&P, Tom at 41.60. Into the bond market, yields higher to 157.67, up by about a basis point. Crude on the back foot, softer, lower, down by 0.8%, $65 and about 12 cents. And the euro, firmer on the day. The dollar is weaker. Euro dollar 120.55. Tom, up 0.4%.
Very good. On a busy day here and coming up on claims in 12 minutes, critically important data. We digress to Washington and we digress to one of the most interesting Congress people of this nation. Warren Davidson is from the Republican Center of Ohio. That would be in the vicinity of Dayton, if I get my map correctly. We won't ask him Indians or Reds, but we will ask him about his expertise in crypto. We will ask him about the moment, but we must begin with our military. Warren Davidson is one of the great stories of the military in our Congress. He was a soldier in Germany and had the privilege to wander to West Point. And we're thrilled that Warren Davidson could join us today. Soldier Davidson, I want to talk to you right now about these reports we hear of politics in our military, whether it's far right, far left, center, or all. How does Washington manage the personal politics of our military?
Well, it's certainly different. You know, when I was in, Bill Clinton wasn't popular at the military academy. People were shocked when he defeated George W. Bush there. The place is a little insulated from day-to-day politics, or at least it was at that time, you know, pre-internet era. Today, you know, the Biden administration started out with kind of a 60-day stand down to review boards and anything with a nominee. I'm on the board of advisors for the United States Military Academy, and we had to take a pause in our action as a board.
There's been a huge deal at Colorado Springs as well. What do you need to see from Republican and Democrat leadership to take this polarity, this polarization out of our military?
Yeah, I think, you know, just keep a mission focus. I mean, when, you know, really the politicians are the ones that tend to politicize the military. The soldiers just want a mission and the resources to accomplish it. I'm sure that's true today as I go out and talk with folks, you know, here at the Wright-Patterson Air Force Base, right near here, the National Guard, Springfield Air National Guard, and units deployed around the country. They just want a mission and the resources to do it, and not all the political distractions.
It seems like everything has been politicized right now, including retail trading. GameStop became politicized in the past 12 months as people bid up the price dramatically as a result of Reddit boards. You're holding a hearing on that 12 p.m. Eastern today. There has been some discussion about shortening the trade settlement times to withdraw any potential risk to Robinhood, like what we saw. Are you for that? Do you foresee that in the near future?
Yeah, I mean, it was encouraging initially. I mean, Congresswoman Ocasio-Cortez agreed with the same position I had and Ted Cruz had initially, which is, you know, more democratic access to capital makes our country stronger. I mean, we have the best capital markets in the world, but we do have a chance to improve them. We are facing dynamic times, as you see. Reddit threads, for example, in this GameStop case, have an impact similar to something that could rival a Bloomberg terminal. So speech on a Bloomberg terminal really shouldn't be treated differently than speech on a Reddit thread. I think we have structural opportunities to improve trading to get to T0.
All right, Bloomberg has read it. I will say, though, there is a question also about how Bitcoin, how Dogecoin, as my children ask me about on a daily basis, by the way, because it is from Roblox, it's life imitates art and vice versa. There is a question of where the regulatory side fits into this, of why we haven't come up with a regulatory framework soon enough. What are you thinking on that front?
Well, SEC Chairman Gensler is going to be before us today. I had the opportunity to speak with him when Facebook was talking about Libra. And at the time, he felt the SEC wasn't doing enough to give regulatory clarity to the market. I look forward to his answers on a range of topics. It's going to be his first appearance before the House Financial Services Committee. And, frankly, I'm optimistic that he'll agree we need some sort of light touch regulatory clarity for this space to continue to flourish. I was also encouraged by Janet Yellen's comments recently and, frankly, by the Federal Reserve's openness to allowing fintech companies access to the Fed payment system.
Congressman Davidson, can Chairman Gensler take a middle ground in the polarity, the hopes of the liberals? Do you suspect that Gensler, as a wizened Wall Street veteran, will find a middle ground?
Yeah, and I think, look, a bright line test for digital assets is a nonpartisan issue. My Token Taxonomy Act is completely balanced with Republican and Democrat sponsors. We started working on this in really 2017, got the draft language in 2018. And as one of the attendees at the meeting we put together on it, people from the community in crypto, but also big companies like Fidelity.
Administration is supporting potentially waiving IP protection on COVID-19 vaccines, many of which were developed in this country and in Europe as well. What's your position on that, sir?
Yeah, I think it's always dangerous when the federal government decides to retroactively waive things like intellectual property. How do you justly compensate someone for this? But I think, look, the company's benefited from a massive amount of U.S. dollar investment, and I think there's an equitable way to resolve this that really does deal with the public health crisis. We've seen a lot of fighting between which administration should get credit for what on warp speed. Well, the reality is it wasn't a partisan issue. It moved through Congress as well. It passed. I don't think anyone really objected to that provision at all. And to the overall package, it was less than a dozen who objected to the initial funding that made warp speed possible. So some of these dollars are U.S. taxpayer dollars. So I think there's a clear claim that some of the intellectual property needs to be able to be managed in a way that really benefits not just America, but public health broadly.
A complicated view, a nuanced view. Congressman,
yeah.
Appreciate
Not a good
your
time
sir.
for nuance, but it is an important topic. I think it's dangerous to change all of IP law the way the president had proposed it, though.
Well, we appreciate the balanced view you're offering this morning, sir. Congressman Warren Davidson there on the debate of the moment. Tom Keene down in Washington, D.C.
It's a debate of the moment, and I'm sorry, but there's going to be more debates. What's interesting, John, is how all of this is moving in real time away from what we spend most of our time on. I'm going to go back to the 6th District of Texas, the 17th District of Illinois. The political landscape in Washington is changing in real time.
Very quickly, Lisa.
Yeah, and I do want to just go back to what he was talking about with respect to crypto assets. People really looking for the clarification there.
Come on, you were just looking for investment advice for the kids on the couch.
You mean that they're looking to invest in Dogecoin?
Yes.
They literally were asking me for levels last night.
Yeah.
They were like, where's it trading these days?
They got a regulatory view just there, Lisa.
They did. They can listen in and find
Coming
out.
up, Joseph Stiglitz,
Congress
Columbia Business School
Yesterday,
professor.
Lisa's get Davison on.
Looking forward to that. He's just around the corner. Yields up about a basis point, 157.32. Equities unchanged. This is Bloomberg Surveillance.
focus is odor detection. And this is because no matter how you're bound, what container you're in, you're still producing and releasing odors. And we're kind of building off of wildlife detection dogs.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
How do you start your morning?
Guess who won the fight in a commercial break? This black eye you've got right now looks so authentic.
You let him get in a good punch.
Wake up with Bloomberg Surveillance, weekdays on Bloomberg Television.
From New York City for our audience worldwide, this is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your economic data in America due out any moment from now. We're looking for initial jobless claims and they are just about across. There they are. Here's Mike McKee.
Well, John, we're continuing to see a decline in jobless claims, exactly as the economy and economists and Fed officials would like to see. Initial jobless claims, 498,000 last week, and that is the first time we've broken the 500,000 mark since the crisis began. Last week's unadjusted number, 553,000. I do have the adjusted number here. Down 92,000 from the prior month's 590,000, so prior weeks. So last week revised up a little bit, but a significant decline, and we get below the 500,000 level. Continuing claims at 3,690,000 is at this point a little bit higher than it was, but those are claims, remember, not people who are out of work. Two other numbers out this morning. Non-farm productivity for the first quarter jumps for the quarter at an amazing rate, 5.4%. This is to be expected when you see a rebound in the economy. Productivity rises because demand rises, and companies got to fill that demand without hiring a lot of more people because that takes time. Unit labor costs fall by 0.3%. This is probably a residual of the fact that the lower paid people in the economy have fallen out of the workforce and are coming back now.
Michael McKee, you and I and John and Lisa and all listeners and viewers have never seen a jobs day like we're going to see tomorrow. The numbers are unimaginable, etc. Put your scope and scale on 1 million plus jobs created after you see this claims report.
Well, there's nothing like it, and I make these charts for a living, and it's really hard to do now because its scale is thrown off.
You can't get it on the page.
You can't get it on the y-axis. It makes no sense. So it is going to be a huge number, but the thing is, it's priced into the markets at this point.
We're going to hear from Jerome Powell. He needs to see 3 data points, 4 data points, 5 data points.
Everybody at the in the markets is saying if we get 1 million plus, as long as it's not so much more, that it won't affect anybody because everybody's expecting this quick rebound. What it is maybe pulls forward the idea of a Fed rate hike or tapering because the Fed starts to see a faster recovery.
And quickly, John Farrell, Steve Englander at Standard Charter was out at what, 2 million would move the needle?
He thinks we need to see 2 million plus to move the needle on the Fed conversation. That's not his estimate. That's just what he thinks would disrupt and recalibrate expectations around the Fed. Well, right now, yields up a little more than a basis point off the back of this, Tom. No big moves, 158 on 10s.
No big, the real yield negative 0.90. This is a joy and an honor. He's been a wonderful friend of the program. The laureate Joseph Stiglitz, Nobel Prize winner, yes, at Columbia Business School, definitive on economics and redefining the Greek letter epsilon long ago and far away was for Sanford Grossman as well in the fancy math of the moment. Joe Stiglitz, let me give you the real world math. Gary, Indiana, fanciest city in the world for economics, the home of Joe Stiglitz and Paul Samuelson, Gary, Indiana went from a pandemic 19% unemployment down to 7% unemployment. That indicates the inequalities of a strange economy. How great is the inequality in this 2021?
Well, the pandemic both exposed and exacerbated the inequalities. We were slated for a very K-shaped recovery, with those at the top who had done well doing even better, and those at the bottom doing more poorly. The kind of numbers that you cited suggest that the kind of very strong economic recovery act that was passed, the $1.9 trillion, is beginning to have some effect and mitigating at least some of that fear of this very K-shaped recovery. It's still there. It's still very clear that in terms of wealth, those at the top have done very well, and those at the bottom are more in debt, as not only the visible debt, but the invisible debt that many of them have not been able to pay their rent for a year.
Professor Stiglitz, I quote you often in the acclaimed Stiglitz essays of long ago on the little g, that what matters is the growth rate. You're acclaimed at this within your teaching in many different spheres. Great. Can we grow our way out of these debt and deficits? Should we have confidence and rely on the Stiglitz little g to help us get out of this fiscal mess?
Yes. I mean, one way of looking at it is just a little bit of history. At the end of World War II, our debt-GDP ratio was 130%. And then there was a bipartisan consensus led by President Eisenhower, a Republican, that we ought to spend heavily on infrastructure, education, R&D. And lo and behold, in a couple of decades, our debt-GDP ratio was down to under 50%. So yes, you can grow out of the high levels of debt that we have. And, you know, right now we're expecting to have very strong growth for this year. We're actually, most forecasts suggest that at the end of this year, we will be better than we were projected to be before the pandemic.
Yeah, and Professor, we're talking about the US economy. Of course, we're not talking about other parts of the world like India, like Brazil. You've advocated for the IP waiver that this administration is pushing through at the moment, or at least trying to achieve with partners over at the WTO. Why do you think that's the right approach?
Oh, well, this is a pandemic. The definition of a pandemic is that it's global. And this particular pandemic is a kind of danger because it keeps mutating. And we don't want a fertile field for those mutations, say in India. We want this disease to be put under control. Nowhere's going to be safe until everywhere is safe. And that's why it's really important to get the vaccine out there as quickly as possible. Now, a major impediment is access to intellectual property. A whole variety of access is needed. The principle has been long established. It was established almost 2 decades ago in the midst of the HIV/AIDS epidemic. The question is how to facilitate it. There's an urgency here, and that's what the waiver is about. It's not changing the basic framework. There was always the right to compulsory licenses since that HIV/AIDS. The question is how to make it happen quickly, and that's what the temporary IP waiver is all about.
Dr. Fauci has doubts about that. He thinks that this could be an unwarranted, unwelcome distraction, that it could take until the end of 22, early 23 to transfer the technology. And then, Professor, we'd have to talk about expertise as well. The starting position of this debate, everybody agrees with what you said. We need to help the rest of the world. And even the most selfish individual has to acknowledge there is positive externalities associated with that. So before we even have this debate, it's done. That's done. We need to help the rest of the world. But Professor, it's how we help them more quickly. Do you acknowledge there are other issues that need to be tackled and that this could become an unwelcome distraction for the other nations that we could be doing more to loosen up the strings elsewhere?
Well, those sound like the talking points from the drug companies, but the point is that the drug companies in the developing countries, emerging markets, do have the capacity. A barrier to their expanding that capacity is the concerns about intellectual property. Several companies in South Africa and India are already producing even the more advanced kinds of vaccines, let alone the simpler kinds of vaccines. And it is really intellectual property that is one of the barriers. Now, another barrier that is related to the WTO waiver is allowing companies to more easily export their products. Under the standard WTO framework, you can get a compulsory license that allows you to manufacture for domestic use, but makes it more difficult to export. But in today's world of global supply chains, where even the ingredients in a vaccine may be made in several countries, the barriers to export are a major barrier to expanding the world's global supply. So that's why it's imperative to have a temporary waiver of all these restrictions.
Professor, there is a question, though, about the economic incentive for companies. And yes, there is this concern by pharmaceutical companies that this removes the economic incentive. However, there are some who argue this could pull them back from innovating, from working harder to come up with new drugs to combat whatever new disease comes our way. What's your response to this, that the economic incentive is that much lower for the pharmaceutical companies?
That's absolute nonsense. I mean, first of all, let's be clear. The basic research on which these vaccines is based was financed by governments around the world. Secondly, the expansion of the production and the development of these particular vaccines received enormous government support, not only from the United States, but from other countries. The amounts of money that the drug companies are going to get on these vaccines are going to be, enormous returns, well in excess of any normal return. What we're talking about here is whether they'll get, say, 10,000% return on their investments or 1,000% return. 1,000% return is enough incentive to make them undertake that research. I don't worry about that.
Well, there's also a question, this dovetails into the larger infrastructure spending that Joe Biden has proposed. And just quickly here, are you in the camp of Janet Yellen that taxes should be raised substantially on companies? And if so, why is it not just sufficient to do deficit spending, which does not seem to have had a problem for this country?
Well, I do agree that eventually we need to correct our distorted tax system, which in terms of the percentage of GDP that is raised in taxes is insufficient to finance a 21st century economy where you need infrastructure, research, education, a whole host of public needs to make a well-functioning economy and society. We also have a distorted tax system, which is less progressive than other countries, less progressive than it should be, particularly given the enormous increase in inequality over the last 4 decades. So the question is really one of timing. The basic law of economics is scarcity of resources, and we've underutilized our resources. We have some capacity to expand production, but eventually we will reach capacity constraints. And then we will have to decide how our resources get allocated. And that's when the issues of taxes become germane.
I won't get into a debate about the efficient allocation of resources with a Nobel laureate, so we'll leave it there. Professor,
it's good to catch up.
Professor Stiglitz, Columbia Business School, University professor.
Thank you.
I've been accused of arrogance in the past, Tom, but I'm not going to take it that far this morning, okay?
It is not. John, did you see what happened on IBM?
What happened, Tom?
IBM migrating down to an A-. You read the S&P boilerplate, and they don't miss any words about it. First line: IBM spent about $1 billion on acquisitions, and then they go on there to justify an A- rating of a certain vintage. We remember early 1992, and I'll tell you, folks, at the time it was a true shock to see IBM lose its AAA rating. John, granted it's 30 years and we all know the soap opera, but to go from AAA down to this moment, I'm sorry.
But no one cares.
No one cares.
I'd love to know what the yield was on a AAA piece 30 years ago.
Yeah, probably
like
12%.
It's probably what high yield is now.
Exactly, probably higher
the
than
junk
that.
equivalent.
Exactly.
AAA 30 years ago.
Now people don't care.
John, equity return from 1992, 8.9%. That doesn't get it done.
Nope. From New York City this morning, good morning, alongside Tom Keane, Lisa Bramwitz, I'm Jonathan Ferro. Equity's unchanged.
Working on those ratings.
Got to run.
Pontificating with a laureate.
This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record.
And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
It's challenging
challenging to manufacture vaccines, and to start from scratch with a voluntary license to someone who hasn't done it before or who's using a new formulation, that takes time. It's very risky and it's hard to do. So I think the approach that's being taken right now is to engage as much of the world of vaccine manufacturers that people can get their hands on and involve the experienced people in the process.
Julia Gerberding of Merck in their Heritage of Pharmacology. Good morning to Gordon Douglas, who began that program ages and ages ago. We drive forward the conversation now here. Yes, wrapped around claims, a good number, on to jobs day tomorrow. The markets, you know what it is about this pandemic. We are advantaged with Samuel Fazeli of Bloomberg Intelligence. He's our EMA Director of Research, but also expert in pharmacology out of the University of London. Sam Fazeli, there's that course at London, LWM 23, on intellectual property and medicine. I think many of our listeners don't understand, our viewers as well, don't understand the copyright law here. What do the drug companies actually own?
Well, Tom, I think Moderna has over 200 patents on its process and manufacturing and the mRNAs and all the various elements that go into it. That actually suggests the depth of expertise required to make these things. Patent offices don't just issue patents, which are obvious things. I mean, they can be challenged, but 200 patents means there were 200 inventions related to this manufacturing of this vaccine. To pass that on to somebody, which your comment was saying earlier, just like that, and expect that they can get vaccine made is really a bit of a pipe dream.
That's right where I want to go, Dr. Fazeli, and this is the one concern of the moment. We're all concerned about helping India, and that number, that startling number, folks, of one company having 200 patents. How does that affect, Sam Fazeli, the making of the medicine? Not who owns the mRNA or the what's in the jab, what's in the shot, but the actual manufacturing process.
Yeah, Tom, I think it actually highlights the complexity of the process if you have 200 possible novel elements that you can patent. The point is India has Serum Institute of India, that is the biggest manufacturer of vaccines worldwide. Why haven't they done the work already? This is something I think that is a failure of state rather than industry here. The company has had access to the AstraZeneca vaccine technology for quite a while. It just shows it's not that simple to make these things.
Okay, let's put aside, though, the procedural aspects of creating the vaccine and go to the money behind this. The question of pharmaceutical companies that say, we were the ones that created this, we should get the money. Otherwise, what's our incentive to create new drugs that are better and greater and can help the public good? Joseph Stiglitz, Nobel Prize winner, just was on talking about how this is hogwash and the government actually financed a lot of the production of these vaccines. What's your take on that?
That may be true for, and obviously I'm not going to possibly say anything to negate what our esteemed speaker said earlier, but the point is that this may be true for Moderna, but it's not necessarily true for BioNTech and Pfizer. It's certainly not true for some of the other companies that have been involved, such as Novavax. I mean, they have had money for expanding their manufacturing, but Novavax has been spending money in developing its technology, for example, for over 30 years. So the point, okay, let's just turn this on its head. Let's stop all pharma companies doing vaccine development, and just the government spend money on developing vaccines. Where do you think we would be right now?
Okay, so this is the argument that basically there is a more efficient allocation of resources within the private sector than the public sector. That is sort of the heart of the debate that a lot of people have been having for decades and decades. Going forward, Sam, how much does this affect the development of new drugs if this IP waiver is applicable in future situations and does go through with the EU signing off?
If it becomes a reality, and if it actually has bite, that's the other thing, right? Because we have to watch with politicians how much there's substance versus form in what they actually do. If it becomes a reality, then I would suggest that anyone who wants to invest in developing future drugs will have to think twice about putting their money in their pocket, rather go and make cars, I guess.
Sam, we're all dancing on a pin. Let me cut to the chase. Viagra, they made a ton of money at Pfizer on Viagra. I had nothing to do with that profit margin. Sam, it's Viagra. It's a damn blue pill. This is about people dying. Why don't we lump some out, Pfizer and the rest of them, and move on to some new modern landscape of pharmaceutical intellectual property? Or are we going to argue about this like we did about generic Viagra?
Would be absolutely great if governments had the foresight, and remember we've had these pandemic response groups for ages, if they had the foresight to actually invest in manufacturing. Why doesn't the European Union have onshore manufacturing to the level that's already ready to just turn the lights on and get vaccines going? Because these things don't come around every 5 years, every 2 years.
Yeah, fair. I mean, that's a great statement. So, Sam, what's going to happen here? What's your date calendar for the next 90 days? The zeitgeist in Washington is this is going to get all pushed back into a soup that'll go on forever. What do you predict?
With regards to the patents, obviously it has to be discussed at the WTO, and I'd like to see it thought through properly. Make the vaccine free and give them the ability to manufacture. Unfortunately, what I'm worried about is that they do that, and then there's still no vaccine, and then who do we blame? So what I want to hear is that vaccines are being manufactured, extra doses are being pumped as much as possible into the countries who don't have them and need them, and then, of course, we need to see more data on these variants as they come along.
Sam Fazili, thank you so much. Greatly appreciated. Truly expert on these issues. Lisa from Fargo emails in and says, I mispronounced Viagra, which, I'm sort of shocked, Lisa, that she would do that. I mean,
I think it's Viagra. That's just my sense. Okay. I mean, honestly, I'm not the target demographic, but
it gets to the heart of the matter. I mean,
this is actually a really important point, and it goes to not just vaccines, but also antibiotics. There is a question of why we have not had more development of the essential medications, why there has been so much focus on things that cater to much smaller subsets of the population, but that can be much more expensive medications. This is the conundrum. Our intellectual property system has been under attack for a long time by all sides, and the question is, how do you rearrange it in a more fair way? This debate will continue to rage.
Yeah, my guess is the debate will rage, but the American pharmaceuticals will just stall and delay as they can as the good news on the pandemic gets better. Our good news is you need to stay with us tomorrow. It will be Jobs Day, without question the most fascinating Jobs Day I've ever seen. I think Michael McKee would agree with me on that. We'll give you complete coverage. Go beneath the headline data at 8:30. In the meantime, this is good with Gensler talking today. Harvey Pitt. I always learn something when Mr. Pitt makes conversation. Balance of power. We'll have Harvey Pitt on this morning. And Lisa, the Gensler testimony is not a small issue.
No, really interesting to see whether he's going to argue for a reduction in settlement times for transactions. Also, Bitcoin. New regulation could actually bring institutions more into this space if they understand the regulatory framework.
Maybe. Stay with us on TV
That's
and
what
radio
someone had to say.
Today. This is Bloomberg. Good morning.
during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
From New York City, for our audience worldwide, good morning, good morning. The countdown to the Open starts right now, 30 minutes away from the opening bell, with equity futures totally unchanged on the S&P 500. Let's get straight to it. We begin with the big issue, gearing up for the payrolls report.
It should be a pretty big number.
Demand for workers is really huge.
Looking for 1 million.
Are we going to keep getting these big numbers?
There is a lot of demand for jobs.
You have to get a material upside surprise.
But there is still a lot of supply.
We're seeing labor shortages among certain industries.
We still have 500,000 initial jobless claims coming in per week.
Significant slack in the labor market.
This labor market is not as strong as a lot of these non-farm payroll numbers will show us.
It's not so much about one report.
What's more important is going to be what's underlying the headline.
The adjustment of wages are really the big story.
There is a wages problem if labor force participation rate does not come higher.
The range of uncertainty is obviously quite a bit larger than normal.
We're looking for a huge number tomorrow. Let's bring in the Bloomberg team, Michael McKee and Kelly Lyons. Morning, Mike.
Good morning, John. Yeah, the median estimate just went up to 1 million, which would be an all-time record for single-month hiring. A lot of people taking a look at what's been going on in the other labor market indicators, including jobless claims this morning. They fall below 500,000 for the first time since the pandemic began. The only thing about that is these are claims, not people. We don't know exactly how many people remain out of work. But the good news is they are falling significantly. It's not the week, as you can see the red dot on the right there, it's not the week that counts in terms of payrolls. That was 2 weeks ago, but they were dropping at that time as well. And you can see the red line there. That's the 2019 average. That's what you're aiming for in terms of a total recovery from the pandemic, 216,000. We'll see how quickly we can get there. Now, that is good news, but the thing the Fed is looking at is what kind of scarring we're going to have. And there's another chart that shows we still have some way to go, and that's total claims. It's people who are getting initial claims, but also continuing claims and the pandemic claims, the gig workers, and you can see we're still a long way there from where we were going into the pandemic. These are people who are still out of work, yet to be absorbed. So tomorrow we're looking at this 1 million gain, and I'm not sure our chart even reflects that because it was revised up in the last hour, 998,000 there, we're at 1 million. The top forecast, John, is 2,100,000. That would take a lot to get there. The unemployment rate does fall and the labor force participation rate does rise, but average hourly earnings fall, and you heard some of the people in your open talking about that. That's because poorly paid, lower paid service workers come back into the labor force, and that pulls down the overall number. Service industry payrolls, we don't have a forecast for that, but you can see how many there were last month. That's the kind of jobs that we are expecting a big gain in tomorrow.
Mike, the numbers, phenomenal. 2.1 million from Jefferies, Goldman looking for 1.3, Lou Alexander over at Nomura looking for 1.3, Morgan Stanley for 1.25. Mike, you ever seen anything like this before?
Nobody's seen anything like it, which is why it's hard to put a lot of specific credence in anyone's forecast. Somebody may be good, somebody may be lucky, but we have no models for this. So the guess is it's just going to be huge because the economy is opening up so fast, and you pays your money and you picks your number.
Michael McKee, thank you, sir. Very difficult to push this through this market. Let's bring in Kaylee Lyons for more on that. Hey, Kaylee.
Hey, John. Well, futures have been fluctuating between gains and losses all morning, and we didn't get any kind of clear direction after that initial claims print. I'm going to call it is exactly flat on S&P 500 futures, NASDAQ 100 futures down by just 0.1%. Stocks in Europe, of course, still lower. And in the bond market, no real fireworks either. We're up a little more than a basis point, nearly 2 basis points on the 10-year yield, sitting right around 1.58%. But it isn't the nominal yield that has my attention this morning, John. It is break-evens, because yes, the Fed is laser focused on this labor market. That is an important part of its dual mandate. But when it comes to the other part of the dual mandate, inflation, the market keeps ratcheting its inflation expectations higher. If we take a look at the 5-year break-even, which gauges how the market is pricing price growth over that time period, we are north of 2.7%. That is the highest going back 13 years, since before the 2008 financial crisis. And of course, a lot of what is feeding in to this story, John, is the rally we are seeing in the commodity complex, those higher commodity prices. And today specifically, I would point to the industrial metals within that, because you have a lot of concern about a supply crunch and surging demand, especially in places like China. And that is what drove both steel and iron ore to record highs today. Iron ore actually topping $200 a ton for the first time ever. You also have copper above $10,000 on the London Metal Exchange at its highest in about a decade, and aluminum at its highest since 2018, John.
Kelly, thank you. Thank you very much. Joining us now, I'm pleased to say, is Franklin Templeton's Sonal Desai and JP Morgan's Thomas Kennedy as well. Sonal, let's just start with you. On this inflation debate, I know your position. You do not think this is as transitory as this Federal Reserve believes. Why is that?
So I just think that fundamentally, when people assume it's transitory, they're just looking at base effects. Of course, base effects are transitory. The issue is everything else we've just heard. We have never seen this quantity of monetary and fiscal stimulus come into an economy which is already doing very well because it's reopening. So essentially, you've got everything lining up. You've got supply bottlenecks, you've got commodity price increases, you've got a huge quantity of stimulus which continues to flow into an economy that is booming. It's an experiment we've never tried before. And so, yeah, I don't think it's transitory. I think that the Fed is very complacent, actually, about its ability to see through this and control it once it starts going up.
Tom Kennedy, does that resonate with you?
Not really, John, to be honest.
Why
I think you have a situation here where if the market was really believing that inflation was not transitory, we should start to see that in the price. The market is believing this flexible average inflation targeting regime, right? You can see forward expectations for inflation around 2.5%, maybe even a little bit above. But expectations in the long run are still very well anchored. You're talking around 2% for a 5-year break even. So the transitory nature of this is consistent throughout market pricing. Now, what Sonia is saying is that there is an expectation that inflation will be higher, and that's true. It's in the price. But a notion that the Fed will be behind the curve is not in the price yet.
I would agree. I would completely agree. I'm not for a second thinking that the market actually has my view. I'm actually saying that I think inflation is going to be higher than is currently being priced by the markets.
Just add to that then, Tom. Why we haven't seen those higher yields? Because I'm expecting a big number tomorrow. We're already expecting a big number tomorrow. Pretty much everyone on the street is. Yet yields are south of 160. Why?
Yeah, no, I think that is the piece of the puzzle that really doesn't make sense. The Fed scorecard for substantial progress to me is pretty simple, John. You have to see that improvement in the labor market. As you've said, that starts tomorrow. Wide dispersion on what, or I shouldn't say it starts, it continues tomorrow, but wide dispersion on what that looks like. But then also their scorecard for substantial progress is belief in flexible average inflation targeting. And that box has to be checked, given what's in the price right now. This market right now is really doing the opposite of what you would expect. Relative to March, you've had inflation expectations pick up, the economy improve relative to expectations we had at that time. The Fed is getting closer to the substantial improvement or substantial progress towards its mandate, yet real rates have gone down, and the market has priced in a lower terminal rate. I mean, this is the opposite of what we'd expect, and there's a lot of short sellers of treasuries out there that are confused or frustrated.
Let me jump in. So now, your view on this, why that data hasn't catalyzed higher yields?
I think we're looking at points in time. And what I would say is I'm not anticipating that the yield curve continues to steepen in the way we saw it in several weeks. I think does it continue to grind upwards? Yes, as it starts sinking in. Something else I would note is that the market we've recently seen keeps pulling forward its expectation of Fed rate hikes. I'm not in that camp. I think the Fed is going to be enormously patient, but I do think inflation is going to be higher. So I'm calling for a longer and greater steepening of the yield curve, not necessarily the Fed reacting to inflation. They keep telling us they're not going to react to inflation. I think the market is assuming, based on what the Fed is saying, that we're not going to see that inflation beyond transitory, and transitory is being interpreted by the market as 3 months. I think there's nothing indicating that the Fed is going to respond if inflation lasts for longer than 3 months. They keep telling us they're going to see through it because they're, in fact, average inflation targeting. They could sit pat while inflation runs forward for quite a while. And I don't think the market is pricing that. That is my point. I don't think it's in the prices right now.
So, no, we're going to build on this conversation. You're going to stay close and stick with us alongside Tom Kennedy. Bloomberg's Abigail Dillittle has some breaking news for us in the last 10 minutes. Hey, Abby.
Hi there, John. We do have breaking news. John Lang has confirmed that they are in talks with KKR over a possible offer. Shares in London are soaring, up more than 13%. That is the best day right now on record, going back to 2015. And John Lang, of course, originates and invests in public sector infrastructure projects. So again, John Lang has confirmed that they are in talks with KKR over a possible offer or buyout. Shares in London soaring. As for some other movers here in the United States, quite a bit to get through relative to earnings, starting out with Viacom. Shares are soaring. Uber, well, actually, if we take a look at vaccine movers, lots of movement here to the downside because, of course, Moderna put up a surprise miss, John. Their first quarter revenues missed estimates, coming in at $1.94 billion. Now, relative to last year at $8 million, huge growth, but relative to the estimate of over $2 billion, not so much. Pfizer downgraded at Mizuho. So we see a number of these vaccine makers to the downside. That could be part of the reason that we have pressure on some of the travel and leisure sector, but more specifically, Norwegian cruise lines, they also reported they missed relative to numbers for cruise lines right now, not such a big deal, but they gave the color that a resumption of sailing in the summer may be difficult, so we see shares of the cruise line operators under pressure, John.
Abby, thank you. Coming up on the program, President Biden remaining open to a compromise, potentially reducing the size of his corporate tax hike. That conversation still ahead with Franklin Templeton, Sonal Desai, and JP Morgan's Thomas Kennedy. From New York City this morning, good morning. 20 minutes away from the opening bell. Equity futures unchanged at 41.60. This is Bloomberg.